or less than 2 hours to cover the fixed income reading material. So the way I want to structure it is that I will do just a small introduction. Then I will just go to the questions, and then when we're solving question, at least we'll be making some comments, and that should suffice for the revision. We have the past videos for you to go through if you want some kind of basics that are more than what we're going to be covering today. So fixed income the weight of fixed income is 11 to 14%. So meaning that we are looking at 20 to 25 questions in the exam, which is very significant. If you look at it, that ethics had 15 to 20%. Then the next weight is just the fixed income, equity, and FRA. They share the same 11 to 14%, which is very significant for the exam, meaning that for you to be grounded in level 1, for you to be very sure of yourself, you have to make sure you push these topics above 70. And then everything, not only this, I mean, push them above 70, but then the weights will actually guide your study. It's very important to make sure you push everything above 70, and it almost guarantees a pass, right? All right. So for fixed income, it's very loaded. We have different areas of this fixed income that we want to cover. If you look at the learning outcome, the content, you see that we have from 1 to 19. So we have like 19 modules. We have 19 modules in this fixed income, and we're going to be covering all the 19 modules today in 2 hours. So you can just imagine what we have to do. So what I did, I selected some questions that I think will give us a good sense in terms of the revision. So we're going to be solving the questions together after I provide what I think is a good background for the reading. Now, if you look at this content, you will see that the way we're going to be dealing with this is we'll take these two together as one. So talking about the features, we take this will be talking about the market issuance and trading. And then this will be telling us something about valuation. So valuation will be up to this. This will be valuation. So we'll cover valuation here. And then we'll see risks and return will be here. Then we have credit risks will be here. And then we'll be covering mortgage-backed securities. Yeah, so that's how I did it, so that we don't waste so much time looking at each of the 19 modules. Now, the first part is actually to look at the fixed income securities reading. So this will be reading 49 to 50, which will be the first and second module that we're going to be looking at. Now, the first thing to be very conversant with, and you must be conversant with this when you are doing the fixed income exam or the CFA exam. For fixed income, you must be conversant with those 5 basic features of the fixed income. So these 5 basic features, we'll talk about them. One is the issuer. Then the other one is maturity. Then we have the par value, or the principal, or the redemption value. And then we also have the coupon. So you call it interest. We also have the coupon. And then, so this is 1, 2, 3, 4, and the 5th one is the currency. So every issue will have a currency, and those are the 5 basic features of a fixed income instrument that you must know. And attached to these features, attached to this are different things that, sorry, I have to, that you also need to look at. Let me see if I have a message. All right. So now, if you look at issuer, you're saying who is the issuer? The issuer is the borrower of the security. The borrower is of the money. The borrower could be different. We have sovereign borrowers. So if it's the government that is the issuer, we say it's sovereign. If it's not, we have also non-sovereign government. So those are issuance by subnational. So they are not the government, right? And then we have the quasi-government entities. So like agencies, we call them agencies generally. And then we also have the supranational. So these are multilateral entities. Like the World Bank making an issue, we'll call that a supranational issue. And then we have the private issuances. So those are companies and corporations that are private, and those are at other layer and level of issuers. The other one that we tend to classify differently is the special purpose vehicle, which is also special purpose enterprise, which is used to do for securitization. And then, so it's the structured finance, we call it, is seen as another category of issuance. So those are the issuers of fixed income security. And it is important for one to know the issuers because the issuer usually determines the credit quality of the issue. So when you are dealing with the issuer, you want to know who is the issuer. Of course, government issues are more liquid. Government issues have more less credit risk or more in terms of the credit quality. The next thing that I want us to look at is maturity. Maturity is the tenor. Maturity is the tenor of the instrument. Now, the good thing about maturity and the importance of maturity is that it determines whether an instrument is a money market instrument or a capital market instrument. And what the maturity that we talked about here, the maturity we're discussing here is the maturity at issuance. So the maturity at issuance determines whether an issue is a money market issuance or a capital market issuance. And I start with this question. So I want to ask you. So if we, for example, if the maturity is if the maturity is less than 1 year or below, we call it a money market instrument. If the maturity is more than 1 year, we say it's a capital market instrument. So this is the question I usually start with, and I want to ask you. So if we have an issue that exceeds a fixed income security that was issued like 5 years ago, and now the issue, it has stayed for 4.5 years. So it has only 6 months to maturity. So it has only 6 months to maturity. Can that instrument be classified as money market or capital market? Just signify, let me see you post something. Can that instrument be a money market? So 6 months, just 6 months to maturity, that is what is remaining. Money market, capital market, money market, capital market. Money market is taking the day, money market, money market. If you don't post, I will call it off. Money market, okay, I have the first capital market coming in. I have money market, capital market. All right, so remember what I said, that the difference between classifying it as money market or capital market is actually the maturity at issuance. So it doesn't matter whether it is 6 months or 2 months again that is remaining. As long as we classify it at the beginning, at issuance, as a capital market instrument, because when it was issued, it had 5 years, and so we said it's a capital market instrument. As long as we classify it as capital market instrument, it remains a capital market instrument. So I give you an example. If we have someone that is called Uba Jeremiah, for example, and I just fictitious name, right? I just picked Uba Jeremiah, and then we said, if we have Uba Jeremiah, for example, and we gave him the name from the beginning, it doesn't matter, again, he retains the name up to the end. And that is the thing with here. You don't change your name, you retain it when we say you are a capital market. So even though it has 6 months to maturity, it will still be a capital market instrument. That is the importance of maturity. And we're going to be seeing some issues around maturity when we talk about duration, when we talk about valuation of the fixed income security. We'll talk about more on the maturity. Now, let's turn our attention a little to the par value, what you see as principal amount. We call it the par value. Some of you call it the redemption value. Some of you call it the capital amount. Whatever you call it, it is the amount at the beginning that you give out, and then upon which coupon will be calculated. So the par value is very significant because even the price of the bond is quoted as a percentage of the par value. And so this par value you see also determine sometime around when a bond is said to be premium, par, or discount. So if a bond is trading at the par, based on the par, we say it is it's trading at par. If it is above the par value, it's the premium. If it's below the par value, is the discount. Another thing that we may later see around the par is how the cash flow, how the par is being paid off. So it can be a bullet, meaning that the payment is done once at the maturity. And then it can also be amortizing, meaning that we pay the principal and interest along as we move towards maturity. So let's keep that in mind. We're going to be talking about that again later, because remember I said the percentage, the coupon is based on the par value. So what is the coupon? The coupon is the interest. You see here, we say is the interest. That is the amount you pay periodically for the use of the money, right? It's for the use of the money, you pay the coupon. So the coupon is the interest that you receive as the bondholder. If you invest in a bond, you get the coupon. Now, this coupon and the coupon frequency are very important. Some bonds are said to have fixed rate. Some have fixed rate, some have floating rate, some have actually zero. So we can have fixed. If it's fixed, if we have fixed, I say we can have fixed, we can have floating, what we say is a floating rate note, and then we can have zero. So a fixed just means that it pays you a fixed coupon till maturity. So you collect a fixed amount. So like in this case, they say 3.2% fixed coupon. So it will be 3.2% till the end. And then you also have a floating rate note. So this one is, you have a reference rate. It will give you there will be a reference rate, and then you have what we call the spread. So the reference rate is usually the MRR, the market rate, and then that rate is what will be applied that will be changing, and then the spread is fixed. I will leave that because we have questions that will test us. We also have the zero coupon, which is a pure discount bond. All those things are attached to the coupon, which is the interest, as we call it. Now, another thing that you are not seeing here, but then it's very important for every bond and every issuance, is the issue of currency. So every bond that is issued must be issued in a certain currency. And so why is currency very important? Very important concept in fixed income is the fact that when interest rate goes up, the price of the bond will go down. Now, the price of the bond will go down. It's actually related to the currency of the bond. So if, for example, a Nigerian government, and listen to me very well, if the Nigerian government issues a bond that is denominated in USD, Nigerian government issued a bond that is denominated in USD, and the Central Bank of Nigeria increased interest rate. So rates have moved in Nigeria, have gone up. Please don't expect that the US dollar denominated bond, the value will go down. No, the value will respond to Fed. If Fed is increasing rate, even though this issuance is done by a Nigerian government, if Fed is increasing rate, the bond will come down in value. And that is because the response is to the response of the currency of denomination. And then there are two things you need to know here about this currency. There are two types of currency in bonds. We can have dual currency bond, and then we can have currency option bond. A dual currency bond is a bond that gives you income in so the coupon in one currency and then the principal in another currency. We also have the currency option bonds. For currency option bonds, the investor will have the option of selecting between two currencies, which one will be paid. So I have so many things to talk about, but I want to just introduce this concept generally so that when we start solving questions, you see some sense in them. And then we have the seniority that we see here. It's just talking about the ranking, the debt ranking. So of course, we say some will be senior secured, some will be senior unsecured, some will be subordinated, and all that. And we're going to look at them together, right? So so many things to talk about. We need to look at what is global bond, what is Euro bond, what is national bond, what is domestic foreign bond. But then maybe by the time we do some questions around those things, we should be able to take care of these issues. Good to go? Yes. Good to go? Yes. Forward ever, backward never. So we move. All right. So you see, when you are doing exam like this, the first thing you see is those kind of question when they come. You see which type of fixed income security is most likely to have coupon payment that is set periodically. When you see this kind of question, my advice is that, you see it's a cheap question, right? Please don't frown in the exam. Show some smile so that God will know that you are happy. So because if you start just faking it at the beginning as if it's difficult, my brother, I won't say the end though. Just tell me your answer and we'll move on. Okay, good. All right. Yeah. So correct. So this will be our floating rate note. If so, anyone you don't get, please just note it, and then you ask. You can also follow us and ask some questions. So we move. Which type of fixed income security most likely have a coupon that is set periodically? Is a floating rate note. Convertible bond just gives you option to convert to equity. Callable bond just give the issuer the right to convert to call back the bond. You see, if there's another one, just keep answering, and if you answer it well, just be marking yourself, and then at the end of the day, you may see if you can buy yourself something to say, yes, I've tried. Yeah, just giving you some few minutes to read and show your answers, and then I'll move. Again, don't pretend. It's easy. It's just God that gives you the opportunity to get it right. So thank him and tell him that you need to get more of these easy ones in the exam. Yeah, 0.5%, which will be 22.1%. Yeah, good. You're good. So far, so good. The faster we move, the better for you. So there is something also called bond covenant, bond indenture. So what is the answer? You know, we're doing revision class. So someone said if I can do the calculation, I've done the calculation actually. 1.6% plus 0.5% equal to 2.5, because it's so easy. That's why you're asking for calculation. When you see calculation, I hope you will not run away. Let's. All right. So good answers. Just keep them coming. Yeah. Sorry, did I miss something? All right. A contract between an issuer, what will you call this? Yes, so this would be a bond indenture. So if you look at the fixed income instrument, the fixed income instrument is a loan, is an IOU, is just represented by a contract, a borrowing contract or a lending contract between the lender and the borrower. And so the document that guides that transaction is what we call the bond indenture. And then in the bond indenture, you have the covenants, you have the description of the bond, and then the payment, and all that will be in the bond. So the analyst here in this description actually describing the bond indenture. All right. Which of the following is not likely to be a negative covenant? So we have positive covenant and negative covenant. Positive covenant is administrative. You are answering. I'm just talking. Positive covenant, it's administrative in nature. So it's just telling the issuer to do what they naturally should be doing, right? But negative covenants are restrictive. So they restrict the ability of the issuer to do some things. And that is the way we look at it. And that is how we simplify it. So if you see a restriction, so like for example, if you are saying your debt to equity ratio should not go above this, you are not going to be allowed to borrow from this market again. No, you are not going to take money above that will rank above this. This will be restrictive. But in this case, what you have is say which of the following is least likely. So it's not a negative covenant. And which one is not a negative covenant? The requirement to pay withholding taxes to foreign government is the normal thing that you should be doing, and it's not restrictive in any way. Yeah, least likely. Good. So the way you heard me when I read it. So when I in the exam for me, whenever I see least likely, I will just tell myself not likely, and then I will not even be looking at possibility of whether it is going to be correct or wrong. I will just take it as not likely, and then I'll move on so that I don't get confused. All right, sharply, I will move on. Which of the following embedded option most likely provides a right to the issuer? This one, John, don't waste time here. Give us your answer. Daniel, you have to look at it again. You can look at it again. Yeah, look at it again. That provides a right to the issuer. Provides a right to the issuer. To the issuer. To the issuer. Good. So, a callable bond, a bond that provides the right to the issuer will have a call option. So call feature will help the issuer. Put feature will help the investor. Conversion provision is also for the for the investor. So, and then also it's good to note that when you have these options, they have a way of changing or determining what you pay at the end as coupon or as the yield. When it's a call option, you are expecting that because the issuer is the one benefiting, the yield on the call option relative to a straight bond, the yield on the call option will be higher. The issuer will have to pay for that option. And then if you look at it for put option, the yield will be lower because the investor is the one paying for the right to that. So very important as concepts for you to understand. Conversion is so if you have these things given to you in different prices, you should be able to know which one will be cheaper, which one will be more expensive, depending on what you have in there. I will just move. I think I will just move. Yeah. Okay. I think this, yes. This is another question that I also like. If you remember the amortizing that we talked about, we say we have amortization can be fully amortizing. It can also be partially amortizing. When we say fully amortizing, what it means is that in a fully amortizing security, the whole amount is going to be paid the interest and the principal will be paid from the beginning, so that at the end of the day, what you have is zero. But if it is partially amortizing, a certain amount of the principal will be left to be paid at maturity. So if a bond is amortizing, it means the bond is paying part of the principal from the beginning, and therefore the bond is reducing the credit risk that is outstanding. But a bond that waits till maturity to pay the bullet, you'll be carrying the risk. So the credit risk is like you are carrying the whole weight of the credit risk. So that is what that means. However, the one that gives you this periodic payment, so amortizing bond, if this question has asked in another way, the amortizing bond, because of the kind of payment, if it is large payment that is coming to you, will give you more reinvestment risk, because now you have more money to now reinvest. And so it is giving you periodic payments that will increase your reinvestment risks. Good so far? So far, so good? So sometimes it's not everything, it's not every option that you want to talk about. Sometimes leave the examiner with some of the options to be able to enjoy the benefit of being an examiner. You get, but then so that is just what on the lighter note, Joe. So lower near-term cash flow. You should be able to answer this now. Which one will give you a lower near-term cash flow? If it's near time, you don't have so much cash. That's what we are saying. It's related to the lower reinvestment risks as well. So when we say it's higher reinvestment and then higher near-time cash flow, that's the way you should be seeing it. Good. So forward ever, backward never, we progress. Go on. This is another question that I also like, and I want you to master it well. Something I want to say, most of us also sometimes make mistake and think that when you go into the fixed income exam, you want to be seeing calculation, calculator calculation. So anything you see, your eye is going to the calculator. Anything you see is just to calculate. It's not sometimes you can go to the fixed income exam and you see that most of it is just this kind of question that you see coming. All right. So I already have people that are telling me that the answer is B. Which of the following is less likely to be an example of a Eurobond? Yes. So if it's a Eurobond, so generally the way you pick out a Eurobond, and then I think it's better we start with what is the domestic bond. A bond that is issued. So this is a bond that is issued in a certain jurisdiction. So in a local jurisdiction, and so the currency of that jurisdiction is what is used. The issuer is in that jurisdiction. The currency of issue is that jurisdiction's currency. That one will be a domestic bond, and it's usually registered. They will register it. Then you also have the foreign bond. A foreign bond is issued by a foreign entity in the domestic economy. So somebody like MTN Nigeria, I like giving examples sometimes because it's clearer. MTN Nigeria issuing a bond in Nigeria denominated in Naira. That would be a domestic bond. MTN South Africa coming to Nigeria to issue a bond denominated in Naira. That will be a foreign bond. All this one, both domestic bond and foreign bond are registered bonds. So they register them in Nigeria. And then together, domestic plus foreign bonds gives us what? National bond market. That is the national bond market. We are proceeding. Now, the next category is the Eurobond. The Eurobond, the way you look at the Eurobond is that it is unregulated. So it is issued outside one country jurisdiction. So the way you see it, it used to be the bearer bond. But now I think it's no longer like the bearer. But then there is, it is not issued out of any one jurisdiction. So it is, you see something like less regulated, something like outside one country jurisdiction, something around issued to the general international community. So things to tell you that it is not a domestic bond and it is not a foreign bond. So these bonds are looked at and you say, these bonds are what? They are Eurobond. There is something I want to correct for most of us. When we say Eurobond, the idea is that Eurobond has to be issued in a jurisdiction that is separate and then in the currency that is separate. Please, a country, we can actually have a Eurobond that is issued. For example, I know Nigeria cannot do it, but then I'm saying Nigeria can issue a Naira denominated Eurobond. So don't just get it wrong. There can be a Eurobond that is denominated in the currency of that issuing entity. I don't know if I'm clear, but then sometimes that is the advantage of being here. I will just say it and you take it. And then you have the advantage of going to review it. All right, just laugh it up and then we move. We are meant to move. So that is Eurobond. We talked about the national bond market. Now, sometimes, so Eurobond not registered in any one jurisdiction, but sometimes you can have a bond that is registered in a certain jurisdiction, and it's also a Eurobond market. It's also in the Eurobond market. That kind of bond will have a feel of the national bond market and also the Eurobond market generally. And that is what we call the global bond market. So a global bond is issued in one domestic bond market and also is issued as a Euro in the Eurobond market. I hope that makes sense. So a global bond will have a domestic presence, but then we'll also have a presence in the Eurobond market. So that is just to provide some clarity, and then we move on with this. Yeah. So here's another one. Yeah. Okay. I hope you are recording it so that at the end of the day you tell me you got everything. Yeah. Correct. So this is correct. And then we move on. Now, this one, somebody actually asked me that wants to know if we can use calculator. This is actually from the curriculum, asking if we can use calculator. And usually what I advise in my fixed income class is that this calculator that you see now, I still have my own that I use for my exam. This calculator is a very big investment. In fact, it was a big investment for me. When I bought it, it was the most expensive calculator I've ever bought in my life. So I told myself that it must be used judiciously. So, depreciation rate, some people can say it's 25%, 15%. No, I said the depreciation rate can be 1%. So I will continue to use it until when it gets to a level where it will say, no, I don't do again. And even at that, I will change battery. I will try and make it do again. So the idea, what I'm saying is that if the calculator can do something for you, please make the calculator do what it's supposed to do and relax your brain. Relax your brain. So let's look at this. So if you want to do this with a calculator, the idea first is that you have to use the time value of money side first to calculate the payment. You have to calculate the payment. So if you start with your time value of money, 10,000, put this as your present value, 10 million, because they say calculate the periodic payment. It's an amortizing bond. So for amortizing bond, it will be paying principal and interest together. So you want to know what is the principal that is paid in the first period and what is the amount. So what is the principal in the first period? What is it? I want to also extend to ask you, what will that be in the last or in the fifth period or so? So in the calculator, you have entered your 10 million as your present value, and then you have your rate is semi-annual because we're told that it's in semi-annual, so 2.75. We divide that by 2, and then we enter that as our IY. Oh, I don't think my own work. 2.75 divided by 2, and that's my IY, yes. So I put IY 1375, right? Yeah. And then we'll also need our semi-annual periods. And so we'll enter 10 as our N, right? And so we ask to compute the payment. And so the payment is giving us 107. Why is my own 107? I did something wrong, I'm sure. 71 7.36. Let me check, because the whole amount shouldn't be. Yes. So I think I entered okay, this is 10 million, not 1 million, right? Yes. Correct. So let's move. So we calculated 1,077,173.65, correct? So what the question is asking us is to calculate, to give us what is interest and what is component of the first payment of the fully amortizing bonds, so the interest and the principal. So the second thing we need to do is to go to the second function, amortization. That's second function, PV, amortization. And here we see P1. P1 for this sake, P1 will be 1. P1, 1, and then the P2, when you do arrow down, P2 is also 2. 1. P2 is also 1. And then when you do arrow down, what you get is the balance, but that's not what you are being asked. What you are asked is the principal. So here, the principal out of this payment, what we are saying is that 939,673.65 will be the principal payment, and then 137,500 will be the interest payment, the interest element. So what this means is that when you can actually period 1 and period 2. Somebody said, what does P1, P2 mean? It's period 1 and period 2. So if it's a monthly payment, it's saying month 1 and month 1, P1 is which period do you want? So for example, we are going to change this thing. We are going to change second function amortizing. We'll say P1, we'll make P1 to be 2, P1 to be 1, but then P2, we'll change it to 2 and then enter. And so when we arrow down, what we'll see is it will be 1,892,267. So this one is saying that cumulatively, what we have paid as principal with the first period and the second period is 1.892. This is what it's saying cumulatively. And if you do arrow down and you see 262, it's saying 262 is what we pay for the 2 periods from the beginning. So it's cumulative. So if you want to calculate for a certain period, you limit the P1 and P2. If you want to calculate cumulative figures, you just put P1 and then the P2, you put it in another, you put the period that you want. I hope that is clear. So that's the use of the calculator in doing this calculation. So if the examiner is asking for what will be the periodic payment in month, in the third year, you should be able to also calculate this without giving yourself the headache. All right. Forward, ever, backward, never, but we are conscious of the time as well. So I will be moving on. Some questions, I will just leave them. Some I will. Okay, let's see if we can. Let's see. Yeah. Can we answer this? Okay. Okay. If callable, putable bond prices with the same coupon rate will behave most likely like an option-free equivalent bond when their yield to maturity are respectively. No, so P3 just means that we are saying, yeah, we want something around period 3. So if you say, for example, if you say it is always, there will be no P3, there will be P1, and then there will be P2. P1 will say, which period am I starting with? And P2 will be saying which period am I ending. So you see the first one that we did is P1. P1 is 1, and P2, it was 1 too. So the same thing. That is what it means. It's not like there will be there's no P3. If you want to calculate for period 3, you make P1 to be 3 and P2 to be 3. So it will give you the period 3 value. All right. Good. Answers coming. You know, sometimes when I see answers that are varied, I will just be so happy sometimes to say, this examiner has done a good work. You know, it is like the examiner has taken his time to actually gauge you all and then put the response, the questions there. So a callable bond and a puttable bond. The call option in the callable, remember the callable bond, the issuer will call the bond when interest rate is below the coupon. So for example, the person is paying a coupon of say, for example, 4%. And then now the coupon in the market is, the interest in the market is 2%, for example, meaning that the issuer can actually come to the market and borrow at 2% and pay you off. So he will, the call option will have more value if rates are decreasing. However, if it is above, if the coupon rate is above, if rates are increasing, it will not have value. So if a callable bond yield to maturity is it's rising above its coupon rate, then the call feature is not valuable, right? It's not going to be valuable if it is going up. If it's the yield is now above the cost, so nobody will call the bond. The option will not be valuable, and so that the bond will be behaving. The callable bond will be behaving like a straight bond. That is for that. And then the puttable bond has the put option in a puttable bond has more value when the opposite side, so interest rate is high, that is when the option is there. So when interest rate goes down now, the put option will not have, the put option in the puttable bond will not have value, and so the option, the puttable bond, will be behaving like a straight bond. That is the idea behind that. All right, let's move on. I think I will leave this current price. Okay, let's do it. It's cheap, so you know I because it's cheap. I think we can do it. I'm not seeing answers coming, or is it because it's cheap? Okay, so for this, since I'm not seeing any answer, I will just assume that it's part of those things that are that difficult. Or is it it's network that was holding it? Now I'm seeing them flowing. So yes, is annual coupon divide by the price, and so it's straightforward. Annual coupon divided by the price will give us our current yield, and we should also be able to calculate the simple yield. The current yield as a price option is just saying that this is a running yield, like just like it's like your dividend yield. That is what the current yield is. And then you also have the yield to maturity, which is the bond's internal rate of return, and we'll have yield to maturity. We'll have those other three assumptions that they have. So I will just move. For simple yield is actually like the current yield, but it takes care of amortization of discount and premium. So it will be plus or minus the premium or discount amortization, right? Premium or discount amortization. So it is taking care of the fact that you bought a bond at premium or at discount. So that is what the simple yield is doing. Just adjusting that formula, the numerator of that formula for that function. I think I will leave this. I will also leave this. And then let me come here. Yes. So this is another one that you want to use to test your understanding. This one. This one, another interesting one. Another interesting one. I have P, I have V, I have call. I know this is like this. I know this is like this, and this is P, and this is my C bond, and this is my A. Yeah. So how are we doing? Yeah. How are we doing? Yeah. So you see, this is one of the questions that can make you think. Yeah. Correct. Bond B that has a put option benefits the investor, and yield spread will be less than 6, which has no option or benefit. So what I thought I'm explaining, I'm saying, you saw what I did. I'm saying that, so what I did was to say, usually if I have a puttable bond, I have a callable bond, and I have a plain vanilla bond. The puttable bond will be less than the call. So the puttable bond in this case is, which one is the puttable? The puttable bond is B, right? The bond are otherwise identical. The manager and his assistant, bond A and bond B should. So bond A allows the issuer to call the bond before the stated maturity. So bond A is a callable bond. Bond B, so this bond is a callable bond. Bond B allows the investor to put the bond back to the issuer. So it means B is a puttable bond. You get? So C has no embedded option. So in terms of yield, we are saying that the puttable will be less. In terms of yield, the callable bond will have higher yield than the straight bond, and then the straight bond will have a higher yield than the puttable bond. I explained this the other time. I explained this. Embedded option means that the bond has an option that is in the bond. In the bond just means that it is embedded in the structure of the bond. So embedded option can be a callable, but it can be callable, it can be puttable, and embedded can be convertible. So you can also have embedded option in that kind of bond. So those are, but usually in our conversation, when we say it has embedded option, it is embedded put or embedded call option. I hope it's clear, so that we know that all those ones, call option, put option, and convertible, are all embedded. They are in the structure, within the structure. And when we say embedded, is to separate them from sweeteners. We have convertible. I don't know if we have a question there, but then there's also another kind of bond that is convertible, cocoa. So, but I don't see. I don't think it's here in this question. We have not done it. Okay, let's move on. We have good time to move to another area. So let's move on quickly. This area we are going to look at 51 to 53, fixed income market, issuance, trading, and funding. And I said in this case, we have like 3 modules that we're going to be covering. And so I will just start with questions, and then it will help us to answer. When we do these questions, we'll maybe be able to show some explanation the way we're doing it. So please, let's move a little bit faster. Like I said, if you see a good question, you know how to answer it, please answer it straightforward. Don't pretend as if it's difficult, so that God will not make the next one to be more difficult for you. As you are doing this, we are also praying for you. May God make all the exam to be straight and simple and straightforward for you. May you be seeing my face, praying for you and telling you you are done with this exam. You are not going to write it again. It is passed, it is passed, it is passed. And may it, and so be it. All right. So let's this we have done this before, a similar one, a fixed income security issued with a maturity at issuance of 9 months is most likely a money market instrument, maturity at issuance. Something I don't want you to forget. Maturity at issuance. Something I don't want you to forget. All right. Let's move on. So here, new issuers for which investors are likely to require collateral due to more volatile operating cash flows are best categorized as new issuers for which investors are likely to require collateral. So there are new issuers, investors will likely require that this issue comes with collateral due to more volatile operating cash flows are most likely what? Fallen angels, high yield issuers, or investment grade issuers. Answer, yeah. Yeah. Okay. It seems everybody is with high yield. So high yield issuers will include new issuers that more likely be required by the investors to bring in more collateral because of the force of the fact that they are operating their what do you call it? Their operating cash flow is volatile and it's not stable. So unlike all those investment grade that will borrow based on their own credit quality, at the beginning you see them, they are strong, so they borrow usually unsecured, but you cannot do it with a high yield. Now, what is a fallen angel? So fallen angel, you remember fallen angel story. So fallen angel are those investment grade bonds those bonds that were in the investment grade, and then because of the downgrade, because of a deterioration of credit quality, they have gone lower. Their credit quality has deteriorated and they have gone down, down, down. So they are no longer as credit worthy as they used to be. So this is, I actually have a pity for fallen angels because sometimes it's not even, don't test the money first. When you test the money and then you now come and then you are with people, they will just be looking at you. They will just be reminding you of all those things that you were doing before. So that is the thing with fallen angels. When they are there with the big people, they will be enjoying and then be looking down on those people at the non-investment grade level. Now, when they are pushed to non-investment grade level, they find it difficult to adjust because they are used to the liquidity, the cheapness, the whatever of the investment grade. They would think that they are at that level. But then, that is why I say pity them. They will just have a tough time to adjust. That's the problem with that is a fallen angel. So it's equated to somebody who had money before and now he has fallen to your level. It's your level, not my level. I hope it's clear, though. So let's move. Did we pick an answer? Yes, I think we did. So that I don't confuse someone. All right, so let's move on. Forward ever, backward never, we move. The price of a bond issued in the United States by a British company and denominated in US dollar is more like, I think we have done this, but then what is the answer? Because this will establish that you are truly following me. And this answer you gave on this question is making me happy. As simple as it is, you can see how I'm just smiling. Okay. Oh. I see a counter. So, but then it didn't remove by smile. I see smiling. All right. So it's correct. The price of the bond issued in United States by a British company and denominated in US dollar is most likely to change as US rate is changing. Remember what I said? I related it to the currency of issue. So it's the currency of issue that we should be looking at, please. All right. Yes, I think I need this to explain something also. I can't remember, but then there's another question: the composition of the board of a broad board. Okay, indexes. Yes. Usually, an index is used to replicate the performance of a portfolio. So, generally we define indexes as a hypothetical collection of securities. They don't trade, but it is to represent a certain market or a segment of the market. And so we use it to work on to check the performance of a portfolio. And so we say we benchmark the performance of a portfolio against an index to be able to see the performance of the index. So the composition of a broad bond index will most likely change due to change in A, a maturity mix of issuers, B, the proportion of public versus private issuers only, and C, both. So that is what this is saying. So I have some A's, and then it's like we all agree, all of us are in agreement with A. Unfortunately, before I said, I'm thinking that somebody will just put a hair. You see what I'm saying? So yeah, unfortunately, they started answering C, C, C. So there are three things that I want you to look at now. Now, bonds generally, indexes, equity is different from bond. And one of the things that make equity different from bond is the fact that equity, there's no maturity with equity, but with bond, you see a lot of maturity. So a bond index will not be stable. Usually you see bonds coming in and then going out. And so rebalancing will be taking place. Now, that is also how the feel of the issuers is in the market. Sometimes they will like short-term instruments. Sometimes the market will prefer long-term instruments, and these things will be also affecting the bond. So the bonds are issued by many types of issuers. A broad bond index will now have to reflect all the changes that will happen. Changes in terms of the composition. So how is it? Is it private or is it public? Changes in terms of maturity. Is it longer? How is the maturity? Longer, shorter? How are they doing? And then also changes in terms of the credit quality. How is the credit quality deteriorating, not deteriorating? All these things will be reflected in the bond. So it's a combination of the two, right? Yeah, I think that's what I wanted to explain. There's another one here. Okay, what's the answer? Let me see. All right, we're going. All right, so I move because we know this dual currency bond. We move. Let me see. Okay, what of this one? A bond issue trading at the highest bid offer spread. It's most likely highest bid offer spread. Recently issued sovereign. The recently issued sovereign, we call them, if it's a recently issued sovereign, we call them on the run. So on the run will be highly liquid, so there will be no issue of spread. Recently issued investment grade will also not have this highest, not have, it can have high bid offer spread relative to the sovereign, relative to this, but then this one will have the highest. It will have the highest. Usually, because if they are more seasoned, you see that they are rarely traded. If they are more seasoned, they are rarely traded. So dealers will be quoting a wider bid and ask, and then bid and ask spread is a measure of liquidity in the bond market. The tighter the spread, the more liquid the instrument. The wider the spread, the less liquid the instrument. Okay. Yeah, season. Season has just means that it has taken a long time. Let me see. I'm just moving to see. Okay. So let me just use this to just explain the terms. I know you know this, but yes. Which of the following products provide protection from inflation? So it will be linkers, or what we call inflation-linked bonds. And then we have consoles are those perpetual bonds. You know what floater is. So I've explained console. Console has to do, it's a perpetual bond. So bond with does not have a stated maturity. What kind of bond is this one? Which one do you want me to explain now? I thought I did. Why is not okay? Let me go back. Maybe I need to. Yeah. Which of the following products provides protection from inflation? No, linkers, we call them inflation. In fact, the name is inflation-linked bond. They are the ones that provide protection against inflation. Floating rate provides protection against interest rate movement. The higher the interest rate, it moves, and then it moves with the interest rate. So that is that. Yeah. So what's this? Have you started answering this? Consoles are perpetual bonds. So they are bonds that the maturity goes into perpetuity. All right, good. So good. This is a good example of a step-up coupon. So you see, let me. I think we can. Okay, let's answer this. Or do I move? I think they said we are 1 hour. So yeah. Okay. Yeah. So, which of the following statements about asset-backed commercial paper is correct? This financing is not recorded on the balance sheet of the issuer. Of course, who is the issuer? The issuer of the instrument is the SPV. The bank issues ABCP to investors with a backup credit liquidity line provided. No, the bank does not issue ABCP. Is the SPE that issues the instrument. Investor purchase an illiquid short-term note with interest now by the bank. Investors purchase a liquid short-term note from a liquid, very liquid. It's a liquid note. All right. So let's move on. I think we'll want to hit some certain area. So this is a question that is it's liquid, not illiquid. Yeah, correct. So with this, the only thing I want to add is to give you a general feel for questions in this order. So if you are looking at repo margin, anything that will increase the risk of a transaction, that transaction will increase the margin. Anything that will increase the risk of the transaction will increase the margin. Then also, if you want to make money, if you want to make more money, is to increase the risk of the transaction, right? So if, for example, you reduce your margin, you can increase the rate. If, for example, you change the quality of the asset lower, the collateral lower, the rate can increase and all that. So I just want you to have that in mind, because I've seen some questions where the examiner just tried to change these things around. Just say, if I want to, let's say the person wants to earn, the dealer wants to earn more on the transaction. So if you want to earn more, you have to either reduce the credit quality of the instruments, of the securities that you are collecting, and all that. So anytime, as a general feel, anytime you have this as a general feel, please, anytime you see that your risk is increasing, repo margin will increase, as well as the repo price. Repo price will increase, repo margin will increase. I'm just giving you this as a general one so that you just go with it. and have it for lunch anytime. This question is from your mouth to this question that you say you want to be seen. This is the kind of question that you will see. But I hope, just pray for grace to be able to remember some of these things. I will move on because I've discussed that. Okay, this is another question now. Yeah. So the general thing I want to give also here, so that we don't waste our time. The general thing I want to give is from anybody in a repo transaction. Repo, is two transactions in one. So in a repo transaction, if the dealer is looked at from the perspective of the dealer. So if the dealer is collecting securities. If the dealer is collecting security, the dealer is doing a reverse repo. If the dealer is collecting cash, the dealer is doing repo. So repo is for you use repo to borrow, to get money, and you use reverse repo to collect, to get security. I think that will just give you a general feel. Somebody said I should go back a little. And, we have already said that backward never, forward ever. But then maybe internet is not helping. So I'm going again, Soja. On what now? On what? Is it on the repo? Okay, I said generally in repo generally, if we are doing repo, one person is collecting security and the other person is collecting cash, right? So if I'm doing repo, if I want to do repo, the intent is to collect cash. So we do repo to borrow. If I'm collecting security, I'm doing reverse repo. So that's what I'm saying, that from the perspective of the dealer, whatever the dealer is doing, if I'm, as a dealer, if I go to the market to collect security, to borrow security, to get security, that is reverse repo. If I go to the market to collect cash, that is repo. That's the point I'm making. Triparty repo is a repo where it's not bilateral now, it is triparty. So you have your custodian, for example, who will be in charge of doing that transaction on your behalf. So the custodian will be in charge of the collateral management and all those things that you're supposed to do. It's the same transaction, but then that is the custodian doing it on your behalf. Sometimes we call it the securities lending agent or whatever, whoever you put to be in charge of that. I need to move on quickly. I don't know how I think these are simple questions that you will a bond issue internationally outside the jurisdiction. I think you know that one. Okay. Yeah. So this one, just like the one we did now, if I just say what is the answer, what would be your result? I think I like the movement. Just want to take another sip of my tea while you are battling yourself. I'll be sipping tea. I've paid my dues, so I can take tea while you are starting your own now. Correct. So this is showing that yes, you have understood this. So what is the meaning? Z Bank now has entered into the contract with this corporation, which this person agrees to buy treasury maturing in 10 years and promises to sell it back at this. So this person will be doing, because this person is receiving securities, what we just said, because this person is receiving security, this person will be doing what? Reverse repo. I don't know if it is clear. I want you people to really understand this. I want you people to really understand this. Look at it and just tell yourself, what is the person doing? What is the person? Whoever the question is, the examiner will be clear about that. This is the perspective of the dealer, and the dealer they told you is Z Bank. They said the bank, so it's Z that is the dealer. It's very clear that this is the dealer. So Z, from that perspective, Z is collecting. Just close your eye and just ask who is collecting security. That is all, my brother, my sister. Don't even worry yourself doing any analysis. Who is collecting security is what you ask yourself. Anybody that is collecting security is doing reverse repo. Anybody that is collecting cash is doing repo. Yes, even if it is buying and selling securities, one person is buying and the other person is selling. So what is happening is that at any point in time, somebody is buying, somebody is collecting cash, or somebody is collecting security. Whoever is selling is going to be collecting cash. Whoever is buying is going to be collecting security. The person collecting cash is doing repo. So I do repo. Repo is used for short-term things. So I want to collect. I need money. I have securities. I'll take the security and go and collect money. At the same time, what we are saying is, at the same time that I'm collecting this money, from my own perspective, I am doing repo because I'm collecting cash. Now, the other person is actually doing a reverse repo because he is collecting security. So that's why I rounded everything and give it to you in one end, so that you just hold it and just be happy with it. And just say, tell yourself, who is collecting security? Whoever is collecting security, he's doing what? He's doing reverse repo. Who is collecting cash? Whoever is collecting cash is doing repo, and that's all. Don't add anything. Just hold it that, and then hold it like that, and go and sleep. Just keep enjoying yourself with that. If that's the only thing you have learned here, is it not a progress for all of us? So I think I will just move. Single auction price. I think I will just, okay, let's just move. Forward ever, backward never. Yes. So let's move. Introduction to, so this one too, I don't, the only introduction I will give is, just to clarify, it's, yes, it's at the time of contract. Yes, at the beginning, because it's going to be reversed at the end, right? So we want to look at this reading. This is 54 to 57. This is the demand, right? The issue of valuation. And so we want to look at the valuation of fixed income instruments. Please, I want you to be able, with this reading, I want you to be able to do the valuation of fixed income security. So whatever it is, be able to say that I can value fixed income security using yield to maturity. I can value fixed income security using giving spot rate. I can also value fixed income security using forward rate. So be able to do that, and then we are good. Other things we just follow. But in this reading, there are so many things here. So just be able to, one simple thing that you must know how to do is at least be able to value the bond. So you can calculate yield, you can calculate the price of the bond. All these things should just come to you naturally. And again, the good thing is that the calculator that you have, which we have already discussed about, can do so many things here. In this area, most of the work will be done by the calculator, but they need you to understand them and understand them very well. So 2 readings. And yes, there's an area where I usually talk to my people. This is fixed income valuation. And then it's looking at, when you look at the learning outcome, I'm looking at describe this one. Most people will waste time on calculating matrix pricing. And sometimes they get confused. They don't know what to do. So I tell them that when it comes to metric pricing, please be able to describe it. Be able to say, this is what we do, this is what we do, this is what we do, and then leave it and move. If it's just metric pricing, the examiner said you should be able to describe it. The examiner did not say you should be able to calculate it. He said describe. So be able to describe it, and you tell yourself that at least I've been able to I can describe this. I know how it works. So if a security is thinly traded or it's not even traded at all, I can be able to get the yield of the other securities that are similar in credit quality, similar in maturity, similar in nature. So I can take those three qualities and say, okay, these securities are similar to these other securities. So I can use the yield of these other securities to be able to extrapolate the yield of the security and then get the price. So just be able to know the procedure, just be able to describe what is metric pricing, why are we using metric pricing, should be sufficient for you in this reading. Instead of if sometimes I tell my people that when you read, and then you are studying, but the thing is not entering. You try, it's not entering. Please, one of the secrets that I'm telling you, see, as I'm lowering my voice now so that they will not hear me. One of the secrets that I'm saying is I go back and look at the learning outcome statement. What is the learning outcome statement saying, sir? If the learning outcome statement is saying describe and it's calculation that's giving you problem, I beg you, leave it. Go do something else with your time. As long as you can be able to say you are able to describe it, that is what we want, is it not? So now we can come back to our voice and we can talk clearly now. Nobody heard us, at least. All right. We are good, I think. We are good. So let's continue. Let's move on. So now it is about pricing. And this question on pricing can come in any form. Please just make sure, whatever it is, don't fail any question on pricing. Be able to master the art of pricing. When you say the price of a fixed income instrument is the present value of the future cash flow, that is fine. And that is the pricing. And somebody told me that, because when I said, give me anything that you are giving me as a finance person, if I want to price it, I will just look at the present value of the future cash flow. So he said, so I want to marry now. What I want to do is now, I want you to now give me the value of what I will pay as a bride price. Yeah, which can be that one? I say thin. I didn't say person. I say thin, anything. Just give me anything, not to give me person to say value. Anyway, I told him that if you can get the present value of that person, then do the present value and then sum it up and take it as a dowry. See if you can be able to pay. All right, let's go on. A bond. This. So what's the answer? We'll have to do this. A bond of Apex Corporation have a par value. Again, make sure you use your calculator properly. That's a par value of. So this one is just to use your time value of money. Payment would be 150, I think. Somebody will say, how did I even get the 150? The value of the bond is 10,000 each, and annual required rate of return of 10%. The bond has quarterly coupon. So when you take the annual coupon, you divide the annual coupon by 4. That will give you the quarterly coupon. Just make sure that when you do this, you understand what you are doing. And this will be by 4 too. So I said this. Well, I know somebody will ask me, so how do you get? I did 6%. I did 6% of 10,000. It's 6% of 10,000, and I have my N as 2 times 4. I have my FV as 10,000. So compute IY. Compute what? Compute PV. Yes. Somebody says it's 500. Oh, are you sure? 6% of 1,000, and then I divide that by 4. Is it 1,000? Yeah, 6C is correct. So it's when you divide by 4. So I'll move. Hopefully we are good there. Yeah. This is another area somebody also was talking to me about. So everybody, we are here. Answer the question. What's the answer? A 10-year, 6% semi-annual, if you say semi-annual coupon bond is priced at 98.31 per 100 par value. The yield to maturity of the bond on a semi-annual bond basis is 6.23%. The yield to maturity of the bond, assuming monthly periodicity, is closest to IY, yield to maturity. How do you calculate this? So we are moving from one periodicity to another. And so for me, we will use, while I'm waiting for you to give me your answer, I am doing it here. And what I'm doing is I say second function I convert. So I come into I convert. Yeah, so answers are just coming, you see. People are just providing the answer in their own way, using their own understanding. So here, the I convert function, nominal is the rate that I'm given. The nominal rate I'm given is 6.23. I will say enter. 6.23, I will say enter. Then to the periodicity, they said I should look at periodicity of 2. There is a semi-annual, the yield to maturity of the bond on a semi-annual bond basis is this. So the yield to maturity of the bond, assuming monthly periodicity. So the first thing I do is I move from periodicity of 2 to calculate the effective. The effective is what I have. Effective 6.2. Then I change to 12. And I calculate the nominal. And the nominal is 6.15%. So the answer is this. Any query? Expected. Any query? It is expected. Any query? It is expected. It is expected. It is. Don't worry. We'll do it together. So what I said is this. So the thing is, the 10-year 6% semi-annual coupon bond is priced at this. So the yield to maturity that is given of the bond on semi-annual basis is 6.2. This 6.2, let me clean up what I have here. If it's going to clean up, otherwise I'll just leave it. This 6.2 that I have here is the nominal rate. So in my I convert, I will put my nominal rate as 6.23%. 6.23%. So that's what I'm explaining the calculator. I thought we were doing it together. So in the nominal, you will see norm. So I said in the norm, I put 6.23%. I convert is second function where you have second function 2. Second function 2, yeah. That's I convert. So I put this as my nominal. But then this one as nominal is actually on a semi-annual basis. So if I have 6.23 enter, as I will take it to, I want to go to effective, but the effective I will calculate is based on 2 semi. So CY, my CY, I have to change it to 2. It's 2 periodicity. So if I now calculate the effective will be, if I ask it for the effective will be 6.327. It's always good that whatever you are computing, you have to go to the effective before you get to the nominal. So if this is the effective, the next thing, so this effective is saying that if the the periodicity of 2 is seen as a periodicity of 1. If it's a periodicity of 1, it should have been paying 6.3. Now we are saying, okay, this 6.3, if it is a periodicity of 12, what will be the nominal? So the nominal, if we compute the nominal, so change your CY again to 12 and compute the nominal. And the nominal will give you 6.1506. So this is the nominal. Just put the figure. Yes, put the figure as stated. Sorry, I saw one question. How do we miss that? Please say how you did with the calculator. I think we have done it with the calculator. What else? When do you use the iConvert? Anytime you are moving from, this almighty formula that you have, APR, you remember one formula that you have as if you are saying April. This periodicity thing, when you are moving from one periodicity to another periodicity, please just use the calculator. I don't use that formula. I don't use it. I use a calculator to do. You remember I told you that my calculator was very expensive for me. So I make sure that anything the calculator can do, let it do for me. And that is what I'm doing. All right. So let's move on. My target is that by 3:30, I should be doing duration and convexity. All right. No, it's the same calculator. It's the BA2 plus I'm using professional. That's what I'm using. And it's the same. Whatever is the BA I'm using. Just take, maybe you just take the steps that we have and then maybe make sure you review I'm sure they are going to share the link so that we can review. These things will be on our page. We can always go back to review them. So we calculate effective and use effective to calculate nominal again, correct. So what you are doing, this is the logic. I have 12.2%, but this 12.2% is actually on semi-annual basis. So I will say, okay, this 12.2%, I want to convert it to quarterly basis. How can I compare it with something that is on a quarterly basis? So I'll take the 12.2%, I'll convert it to effective first to say, okay, assuming this thing is done, is one period, how is it like? Then from effective, I can now change the periodicity to calculate the nominal of what I want to do. That is how it is. When you do it once or twice, you should be able to get it, and you'll never use your formula again. I'm telling you, you throw it away. Let me tell you this one. You will not waste time doing all those wahala that you have in the curriculum. After all, nobody is giving you Excel sheet. All right, so let's forward ever, backward never. Somebody said, why are we using CY? And I already said forward ever, backward never. Why are we changing the CY to 12? Because they asked us that we compare with the periodicity of monthly periodicity. Monthly is periodicity of 12. Semi-annual periodicity of 2. Quarterly periodicity of 4. Yeah. All right. Forward ever, backward never. I don't know if you know how to do forward rates. I'm looking for something that I can ask, so that I will just move. No, there's no calculation function for that, but that one is straightforward formula. Now, why are you worrying yourself with something that? Okay, I'm just looking for a calculation that will give. This is a deferred coupon, so you just use the deferred coupon method to do this calculation. Okay, what of this one? Okay, yeah, let's do this because I want to be sure you know how to calculate accrued interest, you know how to calculate full price, how to calculate dirty price, yeah. So can we do this? Just give me the answer. Full price. What is the full and flat? All right, here too. So here, we want to use the calculator as well, right? Use the calculator. So if we are using the calculator, okay, somebody has already provided answer. So I will assume that we know how to do that one. So again, it's just to enter it into the calculator. You can get the value using your calculator. So if you don't have, so what? Okay, all right. So what you do is we use the calculator second function bond. Second function bond. That is second function bond is what now? 9. Okay, second function 9. Use the bond function. Use the bond function. Thank you. Use the bond function. Second function 9. Use the bond function. Then enter the settlement date. Use STD is settlement date. So the settlement date, please, if you don't have it, you can just note your own down and follow us later. When you go, you just be practicing. When everybody is sleeping, you just be doing your own. Second function, so the way it is done is you do 6, which is for, this is my calculator, for the way my calculator arranges month first. So you do 6 dot 3013. Yeah, 3013. 3013, enter. Okay, if you have done that, 6 dot 3013, enter, then arrow down. Arrow down. Okay, you see the answers are coming. So coupon is 6. Coupon is 6, enter. And then RDT, redemption value, is given to us September dot 3018, enter. 3018, enter. And then RV is given to us as 100, arrow down, enter it, arrow down. And 2 over y is what you want to have there, 2 over y, semi-annual. Yield for yield is 5, is given to you as 5%. If you do arrow down now, you should be able to get the price. The dot, the point, then I'll use the point. The one beside 0. The one beside 0, right? Price, so you compute price. So when you do arrow down, when you do arrow and you see price, compute. So when you compute, you see 104.558 as the price. 104.558. This price is what now? This is a flat price. This is a flat price. The flat price does not contain accrued interest. So flat price is the price of the bond without accrued interest. When you do arrow down, you are going to be seeing accrued interest of 1.5. So flat price plus accrued interest gives you the dirty price. Flat price plus accrued interest will give you the dirty price. And so the answer is C. 2 over y. I said 2 over y is going to be your semi-annual basis. Unfortunately, you cannot have this. I've never seen a question on the quarterly basis anyway. Oh, sorry. No, it's so you see the second function, what you have seen. They said assume, here it is calculated. They assume you see use a 30/60. So if they say actually you do second, you have to remove, you know this second function enter, this second function set, it will change from actual to 360 for you. You change from actual to 360. After 2, okay, somebody has answered the question. After 2y, arrow down. CY2, right? Arrow up or down. I don't know. I think it's arrow up. See, arrow down. Arrow down. Yeah, arrow down. Is that okay now? You now see yield. You now see yield. No, you don't need to divide the yield. Just put the yield at 5. That's all. Then you do arrow down, you see price, and then you compute the price. So I'm saying at the beginning, you'll see we'll put in the settlement date, 6/30/13. I said enter, which is on your screen. And then you do arrow down and you see coupon. You put in 6 and you do arrow down. And you now see RDT, redemption date. Again, you put 9/30/18 and enter. Then the next thing you will see, if you go down, you will see RV. Redemption value is 100. RV is 100. How do I know that RV is 100? Is what I'm seeing. The prices I'm seeing is 103, 107. It's not 1,000 I'm seeing. Then I'll do arrow down. I will see 2y. If it's 1y, I'll do second function set. It will change to 2y. So I can be changing it. So the next one will have yield, which is 5. And then when you do arrow down, you see price, you just compute the price. So it will compute the price. But then when you do arrow down, accrued interest will appear automatically. Okay, somebody is asking. Okay, no problem. So do this one. Ayokami, I'm answering your question now. So I'm giving you another one. So let's do this. You have this one. And semi-annual. So 2y is to say it is semi-annual. So you have this question. Practice it here. What's the answer? Guys, after this, it will not be fair for me if I don't touch duration and convexity. As even if nothing, I want to confuse you with big grammar, so that you know that I've learned something around duration and convexity. Sorry, just take your time. Don't worry, don't mind me. I joke. Okay, answer has started coming using the calculator. Okay, let me do my own second function, bond. This is May, so 5.1515. 15. Sorry, I'm looking for the, okay, 15. Sorry, it's not May. So it's 7.1514. Enter. Arrow down. I have coupon here, settlement, the coupon is annual coupon. So I will just put 8, enter, coupon 8, RDT, redemption value. Redemption value is the settlement, is here my maturity. So 15, 17, enter. Then arrow down, RV, it's 100. Now I have 360, I have to do second function set. Then it showed me, when I do second function set, it's changed my own to ACT, because this one they said is actual. So arrow down again. So I move to 1. This one too I have to do because it's annual. Oh, sorry, okay, it's semi-annual. Okay, so 2Y, I will leave it as 2Y. So arrow down, yield, is 5.5%. I enter. Price, I say compute. So the price gave me 107. I don't know if I'm correct, but this is the price I got. 107.51. So this is a flat price. Arrow down, 1.326. So, but the question is actually just asking for the difference between the full and the flat price. So the difference between the full and the price and the flat price is what we call accrued interest. You see, very straightforward, very simple. Everything is done for you. Your calculator can do it. If you have my own kind of calculator, before I even go to that area of duration, if you have my calculator, you can actually use your calculator to calculate Macaulay duration, modified duration. You use based on that. I don't know if it's everyone that has it, but I use my calculator to give me duration. For in this case, I have a modified duration of 2.925. I can convert this to Macaulay duration by multiplying this by 1 plus R. All right, good to go. RV redemption value. RV redemption value. The calculator I'm using, I think it's the same you're using, is BA2 plus professional. Yeah, it's the same that you're using. All right. So I should do it again. Texas Instrument, yes. Okay, it's price. What is PRI is the price of the bond, the flat price that is given us. So when you do PRR, you compute, press on compute, and it will give you the price. ACT is actual. ACT is actual. So actual is the other one is 360. So because it's actual, you do it actual. Is that okay? All right. Yeah, we can. The session is recorded. You can always go through it again. If it is 360, you have to do second function, and then you do a second function set. It will change it for you. So I think we'll just move on. Let me just go to. I just have some few minutes. Somebody is saying pricing a bond using spot rate. This is straightforward and forward rate. This is straightforward. All you need to do for for spot rate, you are dividing the denominator by the different spot rates. We have it, but I don't think we'll have time for that. So many questions for us to answer, but there's one question I also wanted to see if I will show you how to do it, especially using this question on FRN, also using the calculator. But please, we don't have time again. Let me just quickly Let me just quickly move on. All right. So guys, you will have the slide to go through. Try and attempt the questions. So many questions that I put on different areas, so that we'll be able to solve so many questions that will be able to give us a good feel of what it looks like in fixed income, and it is affecting different areas collectively. However, because of time, I just want us to move because we have a short time. So just 10 minutes. Let's talk about, we just have like 10 minutes. So let's talk about this area of fixed income risk and return. And this area we'll be looking at the interest rate risks and return. So yield-based bond duration measures. We are looking at the first part. The first is the interest rate risks and return. The second part is talking about the duration. Then we have another one, yield based on convexity and yield-based bond convexity and portfolio properties, and curve-based empirical fixed income. So what I would do is just to give you a roundup and see if some things will make sense before we start looking at them. Now, the first part is actually for us to start. I would just say that you must, as a matter of necessity, be able to calculate the holding period return, right? Just the holding period or return of the bond. We know that the return on a fixed income instrument it would be made up of three parts. So let me just maybe I should leave the return and go to duration, and also try and use a calculator when you are calculating the return. Calculator will give you a better way of doing it. So you see, we have in the return, there are three types: coupon plus the return of the par value would be one. You also have another return, which will be the coupon reinvestment. This is another return. And then you have the third return that you have is the capital gain. So if I'm holding a bond to maturity, I don't have this. This is not going to be part of the return. You will not get the capital gain or loss. This one is only for somebody who is holding for a short period of time. Now, when you want to calculate for the bond return, every time they give you want to get what is the total return. And the total return is just the future value of the coupon. And so it will include the future value of the coupon reinvestment. So if in the calculator you just say it's FV you are calculating, no. Coupon reinvestment. Maybe I should just let me just move on. I'm just seeing that the time is so many things. Sorry. So just be able to calculate this. Let me just make a short statement. If you have investors, so you have two types of investors. One is a short-term investor, and the other one is a long-term investor. A short-term investor will have sensitivity to change in interest rate, while a long-term investor will have a sensitivity to change in the reinvestment risk. So there are two types of interest rate risks that these investors will be facing. One interest rate risk is called reinvestment risk, and the other one is called market price risk. A short-term investor who is going to be selling his bond before maturity will be facing a price risk. A long-term investor who is going to be holding his bond to maturity is going to be facing a reinvestment risk. And we're going to be seeing that because we want to also see what happens if interest rate goes up, your holding periods is different. What do you do? Now, I want to talk about duration quickly. Total return. Somebody is asking me what is total return. Total return is the addition of the coupon payment, the coupon reinvestment income, and then the par value if you are not selling to maturity. If you are selling to maturity, you add the if you are selling before maturity, you add the coupon. You add the coupon rate. You add the bond price to it. Purchase price is the price, investment horizon is this thing. I wanted to do it using calculator because I prefer using calculator for that function. It's actually better. So in terms of duration, please be able to calculate Macaulay duration, modified duration, and effective duration. What is Macaulay duration? Macaulay duration is the weighted average of the time it takes an investment to give us its cash flow. So the time it takes to return the cash flow to the investor. So if you are holding a bond, what is the weighted average of the time that it takes? The longer the time, it gives Macaulay duration is in years. The longer the time, the more the sensitivity. I told you that we can use the calculator in that same order, that same way. You can calculate Macaulay duration. That same way we use the bond function. You can calculate Macaulay duration with that. And then we have, when we get the Macaulay duration, because there's no time, when we get the Macaulay duration, you take Macaulay. You remember that Macaulay duration, Macaulay is equal to modified duration divided by, modified duration. Modified duration is equal to Macaulay duration divided by 1 plus R. R will, of course, be adjusted for the periodicity. So what I'm saying is, if I was able to calculate Macaulay duration, I can just multiply Macaulay duration with I can just multiply 1 plus R. If I do 1 plus R, I multiply my modified duration with 1 plus R, I should be able to get Macaulay duration. So I can move from modified to Macaulay and Macaulay to modified. So if I use the calculator, it gives me the modified duration. So if I get the modified duration from the calculator, all I need to do is multiply that modified duration by 1 plus R to get the Macaulay duration. So that gives me the Macaulay duration. However, the Macaulay duration we get is a yield duration measure that gives us duration. Yes. So the Macaulay duration that we get, the Macaulay duration that we are going to be calculating is a kind of duration that does not give us estimate. We can actually do an estimation of the modified duration. So an estimation of the modified duration is the one that you remember you use formula to calculate the modified duration, where you say it is P, price when yield goes down, plus price when yield goes up, divide by 2 times change in yield times PO. So this time is always not enough. So let me just talk generally. We just have 2 minutes. So all the factors that affect duration, that affect duration. So factors like the longer the maturity, the long maturity, longer the duration, low coupon, longer the duration, low yield to maturity, longer the duration. All these factors are going to be affecting convexity in the same way. All these factors are going to affect. Ladies and gentlemen, so many things to say. We can't finish it. I can't lie. We can't finish it. But I hope we're able to help with this, just to stimulate reading and then to make sure that we contribute in making your reading easy. We cannot say we'll ease your reading. It's just to make it less difficult. CFA, whatever we do, is a difficult exam. Everybody says so. But what we are doing is to make sure that we make it less easy for you. So thank you very much for being here. I can take some questions. We don't have time for. So they will share. They are going to share the slides. They are going to share the slides. I just really comment. I just laugh it. So they'll just share the slides and then we'll see how it goes from there. We can connect on LinkedIn. We can connect on different areas so that we'll be able to still help you in different areas. Thank you. Who am I introducing myself? So thank you. Forward ever. backward never. We are done and we are good to go. I thank you, everyone.
You're introducing me, Musa. Hi, Musa. Hi, everyone.
Oh, okay. My sister has introduced herself already. Mokbe, go ahead, please. Thank you so plenty for coming. Mokbe will be taking the next class starting at 4. Mokbe, thanks for coming.
Thank you, Musa. Well done.
Thanks, yeah.
Yeah. Good afternoon, everyone. Do you need a 5-minute breather or are we good to go? I know we have just 1 hour, but I fear for information overload. Can you hear me?
I think
Musa,
they
can
will
you hear
need
me?
it.
They will need it, Abi.
I think they will need it. Yes, I can hear you, Mokbe.
Okay.
They will need the 5 minutes.
Okay. So we'll take off in exactly 5 minutes, which will be 4:04 because this is 3:59.
So let me take my presentation down. Let me stop sharing.
Okay.
All right. Thank you, Mokbe. Take care. All the best.
Yeah. I think it's right about time. Good afternoon, everyone. My name is Mokwelola Jato. I'm taking you corporate issuers. Please confirm if you can hear me. Anybody, you can type in the chat box so that I'm sure that I'm audible. Thank you very much, Zainab. Getting right to the business of today. So I'm taking you corporate issuers. Thank you, Sadiq. Thank you, everyone. Now that I know I'm audible, because we have just 1 hour, which is barely enough. Let us let's get right to the business of the day. So corporate issuers have 7 readings in all, and that's reading 22 to 28, and that takes about 69 of exam weight. So these are 7 topics, and each of them have their importance, but they're kind of linked and related to each other depending on how you study them. My readings are not organized in this format, but we'll try to cover as much as possible all of the 7 readings. In the event that we're not able to, reach out to me on LinkedIn. I'm sure the CFA Society can share my number and I can assist with questions. In my experience with this, there's usually no time for questions. So there's no point trying to say we will be able to do questions because we need to stop on the dot of 5. So the first reading we're going to be covering is organizational forms, corporate issuer features, and ownership. And one of the things you first think of is, what are the forms of businesses that we have? And I'm sure the most popular one for us is a sole proprietorship business. But before then, what are the things we look out for that differentiate these forms of business ownership or structure? And they include the legal relationship between the issuer, the business owner, the business and its owner, the relationship between its owners and its operators, and whether the owners have limited or unlimited liability. And lastly, what the tax treatment is for profit and losses. In that order, there are 4 major types of business structures. The first one is sole proprietorship, like we all know. Like if me, Mukwe now, decides to own, I'm very passionate about food. I like food. I can decide to own my own amala joint, owned by me, operated by me. Expertise and everything depends on me. That is a sole proprietorship business in its simplest form. An individual owns and operates a business, and I have unlimited liability, and I'm also the only one that has the claim to the profits of the business, and I'm responsible for paying taxes. Now, beyond sole proprietorship, me and my sister, me and my friend can come together and say, you know what, let's start an organization, let's start a company. And based on that partnership, there are 1 or 2 things that define what each person's role is. That is called a partnership. Usually in a partnership, there can be a general partner or a limited partner. A general partner is the one who, apart from owning parts of the business, also participates in the day-to-day running of the business. The limited partner is a partner that is not involved in day-to-day running of the business, but has contributed to what makes the business what it is. So I'll just read this out very quickly. Limited partners operate a business and have unlimited liability, while limited partners are liable only for the amount that they invest in the business. General partners typically receive a larger portion of profits than limited partners, and profits are taxed as personal income to each of the partner. I think this is quite straightforward because general partners are involved in day-to-day running of business. It's only normal that they will have more profit than limited partners. Now, what's a corporation? A corporation is most of the organizations that we know. It's a legal entity where the owners are separate from its operators. It is like a human being on its own with rights, obligations, formed by filing an article of incorporation with a regulatory body. All the owners have limited liability. Do you see the graduation from sole proprietorship, general partnership, limited partnership to corporation? One of the major differences is that in the corporation, owners have limited liability. What this means is that the liability is limited to what they own in the business. If the business goes bankrupt or runs into business problem, it doesn't mean that they will now come for the private property or assets of the owners of the business, because the business itself is a person or a legal entity on its own. Owners are separate from its operators and appoint a board of directors to hire that they hire as managers to help them run the business. Profit may be subject to double taxation if a country taxes companies on their earnings and shareholders on their dividends. And let me explain how this works. So Mokwe and something corporation, no, I can't say Mokwe. Let's say ABC Corporation makes 20 million naira in profit. That 20 million is taxed, corporate tax at say 10%. So that leaves us with 90%. Now, that 90%, if everything is paid in dividend, and in that country, the law is that I would also be taxed, or individuals who own shares in that corporation are also taxed on their dividends. What that means is that this same money that has been taxed, that is only giving us 18 million instead of 20 million, is going to be taxed again to take out of our dividend. And that's just what double taxation means. For profits, corporations can be for profit or non-for-profit. Like we all know, our usual regular organizations, most of us are in business for profit, but are NGOs who are not in the business for profit. For-profit corporations may be public or private. A public corporation may be defined as having shares that trade in an organized market or having at least a minimum number of shares. Now, private companies can become public through the following means: through an initial public offering, through a direct listing, or through acquisition by a special purpose entity. Also, a public company can become private. What I said before is how a private company can become public. Now, let's go to how a public company can become private through different means. A leverage buyer, where a group of people come together, take some sort of leverage, come buy the organization or the corporation, refurbish it, reform it, do what they want to do, and then maybe pay back or sell it or make it public in the future, or through a management buyout where the managers or the operators of the company come together, raise money to buy off the company, and then rejig it because they feel like they have better understanding and they can make more profit or make better decisions that are currently being made. A private company can also sell shares to accredited investors, typically institutions or high net worth individuals in a private placement without becoming a public corporation, meaning they can run because the companies listed it as to report the fund, but private companies are not subject to this requirement. Secondly, claims in terms of claims and lenders and the owners, the interest of companies, lenders, or debt holders may conflict with the interest of its owners or equity holders. Lenders have a higher priority of claims than owners to a company's net assets. So now, while that is, it's two-pronged. And what this means is that in case of a loss, the debt holders obviously have priority to the claims of the assets. But on the other hand, what it also means is that in the case where there is excess profit or limited profit, the debt holders are only they're only able to take the portion of interest and the principal. But the owners of the company, theoretically, and I say theoretically, but what it means is that they have unlimited ability to make profit. While both lenders and owners can potentially lose their entire investment if a company fails, the upside potential differs, meaning that the best that the lenders can get is to receive their promised interest and principal, like I said, but owners have theoretically limited upside if a company succeeds and grows. So on one side, like I said, there is an issue of if there is does have higher priority. If there is limited growth as we see it, then the owners have unlimited upside potential for their investment. Now let's talk about capital investment and capital allocation. Generally, every organization has to make decisions as to how to allocate the finances that they have. In a world where we have unlimited assets, then an organization would just invest in every property, every every investment that brings some sort of results. positive result. But what happens in a peculiar situation as an organization? Now, when it comes to capital investment, there are different ways that capital investments can be analyzed. There are investments that are going concern projects because they need, these investments are needed for, if we don't do them, we can't exceed where we are. For example, I've started my plant of my machinery, my bakery, but to continue to produce at the level that I'm in, I need to service all of my machines or what have you. Now, there are also regulatory and compliance projects that are required by the government. So it is not that you want to do it, but the regulation states that you must do it for you to continue to be in business. For example, safety related or environmental concerns. We also have expansion projects. These are ones that you want to grow beyond your current capacity, and they usually involve complex analysis because they require a forecast of what the future demand is, what the cost analysis is, and what future cash flows are. There are other projects such as new investments outside your existing line, but all of these are forms of investments and involves identifying and evaluating projects for the cash flow of the firm will be which cash flow to the firm extend over a period of time, which means that for whatever I want to use my money for, I want to be able to say that, okay, in the next few years, I'm doing this because of this. But capital allocation process usually involves four steps in the capital allocation process. The first is to generate ideas that's come up with all the opportunities that are telling you or available to. What's happening have been developed. The next thing is to analyze each and every one of them. So look at, okay, or based on what the economy is saying or based on our future analysis, which will be best for us. Now, after that is done, we now create our capital, a firm's capital budget, meaning based on A, B, C, D, this is the amount that we have, and this is the amount we're able to allocate to A, B, C, D. And after that, we decide which of projects we go into. Lastly, we start to monitor the decisions we make at in level 2 and 3. Like I said before, if a firm has unlimited assets, you accept all projects that have positive NPV. However, because in a lot of times our capital is limited, we now have to look at the one we now have to make a decision as to which investments to go into. There are two things that help us make those decisions. One is the NPV and the other one is IRR. And all of these are quite easy on your calculator strokes because there are strokes on your calculator to help you calculate this. If you're going to calculate NPV, you need to know what your CFO is on your calculator. If your calculator is next to you, please pick it up. What your CO1 is, and using your down button, what your FO, F1 is, F2 in that order, and then you'll be able to calculate your NPV or your IRR. Using your calculator, your CFO is your initial cash outlay. Your CO1 is the money you expect to get in the first year. CO2, your FO1, FO2, FO3 in that order represent the frequency of your payments. In doing that, if your frequency of payments is 1, you leave your FO, your FO, F1, F2, F3 in that order as 1. If the frequency of your payments is more than 1, you change that. Please check and make sure, number one, make sure that you always clear NPV or clear time value of money questions whenever you're doing, because your calculator has a memory that assumes that whatever you're imputing or whatever was imputed in your calculator is related to the question that you're solving. So always clear your time, it's called clear NPV function, and then impute your values afresh. Once your values are carefully imputed, you would not get your answer wrong. I personally think that solving for NPV and IRR is one of the easiest things to solve in an exam because your calculator strokes are there for you to use. Now, what is an NPV? For a normal project, this is the present value of all the expected future cash flows minus the initial cost of the project. And this is quite intuitive. I'm going into a business, right? and I'm focusing on what I'm going to put into the business today. But what is also important is over the next few years, what is going to come in for me. I'm sure you already know the time value of money in finance is very important. If I'm going to invest 500 naira today and I'm going to get 200 naira tomorrow and 100 naira, 200 naira next year and 100 naira in 2 years' time, it is different from if I'm investing 500 today and I'm getting 100 naira per year in the next 5 years because of the value of what those monies are if they're discounted to today. So what an MPV really does is it helps you look at, based on what you're spending and what is going to come in, is the project viable? A positive MPV project is expected to increase shareholder wealth. Now, the discount rate used in the firm's cost of is the firm's cost of capital. Note that in solving your MPV question, you're going to put an IRR value, which will be given in the question. That IRR is the firm's cost of capital, and it's going to naturally discount all of the cash flows back to today. So that's what I mean by your calculator strokes already help you in calculating your MPV questions. Now, the discount rate used is a firm's cost of capital adjusted for the risk level of the project. That means if a particular project is too risky, you can increase the discount rate or reduce it based on the specificity of that project. A project that has a positive MPV should be accepted because it's expected to increase the value of the firm, which is shareholder wealth, just as a decision rule. MPV is directly, and I say directly means whatever the value of the MPV is, has a direct relationship to the shareholder wealth. A positive MPV project is expected to increase shareholder wealth, and a negative zero MPV project has no expected effect on shareholder wealth. So for independent project, the MPV decision rule is simply to accept any project with a positive MPV and to reject any project with a negative MPV. And what does this mean? What if two projects are not independent? What if you have to take one at the expense of the other? So what do? You take the one with the higher MPV. So generally, on your calculator, once you're able to put in your CFO, you press your down button and scroll to put in your CO, your CO1, and in that order until you get your IRR. And then at the end of it, you press MPV compute, you get your value for the MPV. Now, MPV is one of the ways to decide whether to take a project or not. The other one I talked about is the IRR. But if I come to IRR, what is the key advantage of MPV? Is that it has a direct measure on the expected increase in the value of a firm. And its major weakness is that it does not include any consideration for the size of the project. What that means is that whether I'm doing a project that gives me 100 million or a project that gives me 100 naira, the decision rule for MPV is to just pick the one that has a positive MPV. But there's something that has to do with the size. The one that is going to add 100 million is harder. But if you're just using the MPV, it doesn't state as to whether one is bigger. It just states that once the MPV is positive, you should take it. Now, let's go to the internal rate of return. I talked about how MPV on this formula is the value of this CFO and then the discounted value of all the cash flows over the period of the time. Now, the IRR is that rate of return in which you discount all these cash flows that makes your MPV zero. In other words, your IRR is that rate of return that makes the two sides of your equation, which is your initial outflow and all of your inflows, equal. And if that is the case, your MPV will be zero. Now, let's understand the IRR a little better. It's a discount rate that makes the present value of the expected future cash flow equal to the initial cost of the project. That is the discount rate that makes your MPV zero. What is the decision rule for the IRR? If the IRR is greater than the project's cost of capital, it should be accepted. What does that mean? I've expended this amount of money to get, I've expended this interest to get this amount of money to invest in a project. How do I decide whether it's a profitable project? I decide if the rate of return I'm going to get on that project is higher than what it has cost me to get the funds that I used to fund the project. If the IRR is lower than the project's cost of capital, then it should be rejected. For this reason, the minimum IRR that a firm requires internally for a project to be accepted is often called the hurdle rate. So what this means is that if your IRR is, or if it's higher than it, you should accept the project. But just like the MPV has its own disadvantages. The IRR also has its own disadvantages. And the key advantage of the IRR is that it measures profitability as a percentage, showing return on each dollar invested. If you remember what I said about the NPV, it's not measured as a percentage. The decision rule is just if it is positive, then you accept it. But the IRR shows you in percentage terms. So you know that something that has a higher IRR in terms of percentage is better than the one with the lower IRR. Now, the disadvantages of the IRR method, which is that it assumes that the project's cash flows are invested at the IRR, while the NPV assumes that those cash flows are invested at the project required rate of return. It is not realistic to assume what the NPV assumes, which is that the cash flows are reinvested at the project's required rate of return. So the point here is that the disadvantage is that it is assuming that the cash flows are reinvested at IRR instead of the project's required rate of return. Another thing is that the IRR, the project can have more than one IRR. And let me explain what that means. If you look at this formula, I'm saying that the K here is our IRR. And first of all, on your calculator, is the same way to calculate it. You put in your CFO, you put in your cash flows, and then you press down and your down button, the arrow button, and you put IRR compute. Now, there is more than one rate that can make your NPV zero or that can make both sides of the equation equal. So at that point, which one do you use? That's the disadvantage of using IRR. Now, let's talk about return on invested capital. A company's return on invested capital or simply return on capital is defined as the net operating profit after tax, or it simply is after tax net profit over a period of time divided by the average book value of its total capital over the period. Now, what's our total capital? Debt and equity. Because return on invested capital measures after tax return on the amount invested by both equity invested and debt holders, we can compare it to the firm's weighted average cost of capital. Like we'll see when we're talking about capital structure or under capital structure. Weighted average cost of capital takes into consideration the cost of debt and the cost of equity. If the firm's return on invested capital is greater than its WACC, then the company's management is decreasing the value to the firm. Now, when we talk about making investment decisions, aside the decisions of whether a project is profitable or not, there are other options that can make a project more profitable. These options that we're talking about here are like the options you have in derivatives, meaning that they give you a right but not an obligation to do something in the future. And some of these options are timing options, which allows the company to delay making an investment because it expects to have better information in the future, or an abandonment option that allows management to abandon the project at the present value of the incremental cash flows from what they have now is exceeds the present value of incremental cash flows of continuing the project. Now, expansion options allow a company to make additional investments in the future if the company decides they will create value. Flexibility options are price setting options, production and flexibility options. Fundamental options are projects that are options themselves because the payouts depend on the price of an underlying asset. Now, when weighing whether to take an investment decision, a capital investment decision, you should be adding the value of the options to decide whether an investment decision will be profitable or not. That there are common pitfalls in capital allocation, which is number one, improperly handling sunk costs. Sunk costs are costs that whether or not you do that project, you've already expended them. So in analyzing whether a project should be profitable or not, you should not include sunk costs. You should include opportunity costs because it means that if you take this one, you're going to lose the other one. Now, also, when estimating cash flows, care should be taken to not overestimate, because if you overestimate or underestimate a cash flow, it directly impacts whether or not the project will be profitable. Let's talk about business models. A lot of us hear the term business models and throw it around like we know it, but the question is, what really is a business model? It explains how a firm provides or proposes that if I haven't started my business, I should have a model as to how I want to do my business. If I've already started it, there are basic questions I should be able to answer as to how I'm doing that, how I find my customers, how I deliver my product or service, and how I make profits. And it's different from a financial plan, which is a detailed projection of revenue and expenses. So that said, a business model should be able to answer the following, which is identify a firm's potential customers. If I'm going into the business of selling amala, I should be able to identify the amala lovers like me, in which area are they most centered, such that I can say, okay, these are the people that are going to be buying from me. If I'm going to go into my business, I should be able to describe exactly what my product is. In selling amala, my product might not just be the amala. It might be that I'm trying to take care of the need of people who, at a particular time during the day, getting lunch for them is difficult. I must also be able to describe my assets, who my suppliers are. I must be able to explain how I will sell my product and my services and explain my pricing strategies. Now, this is where this gets interesting. A lot of times we go into a business of something, wanting to buy something, but the question is what pricing strategy is being used and how do we fit into the whole strategy of the company's pricing style. Now, companies with differentiated products are commodity producers are price takers, meaning that at the end of the day, they can't really determine what the prices are. But industries with few competitors or highly differentiated products have pricing power, which means that they can play around, use that pricing strategy to maximize their profit. Now, let's customers or identify a group of customers. And common examples are tiered pricing based on volume of purchases. You go into a place, they tell you, okay, if you're buying above 10, it will be so amounts. If you're buying less than 10, so it's grouped between 0 and 10 has a price, between 10 and 25 has a price, 25 and above is based on the price. Another one is dynamic pricing, which depends on the time of the day of the week you're buying something. Some people say, for example, it is generally like that. They're much cheaper than if you're buying on Monday. Some people they say peak and off-peak pricing. Some people say value-based pricing. For example, I have Panadol, but I'm now saying that I'm introducing Panadol Fast, not Panadol Extra. So that Panadol Fast will be slightly more expensive than my usual Panadol, because I'm saying that there's a value that this Panadol Fast has that the normal Panadol doesn't have. There's also an example of auction pricing, like you see in eBay. The price you see is a result of a lot of people posting what they're willing to pay for it. All of this just seeks to answer the question of what is my pricing as an organization? How am I using that to maximize my profit? When it comes to multiple products, pricing strategies includes bundling. That's, for example, when multiple products are complementary. For example, you want to rent this apartment, but they're telling you that the AC, the chairs, the gas, the furnishing comes with it. Now, there's also razor and blades. That's selling a piece of equipment for a low price and profiting by selling a consumable used with the equipment at maybe at a higher price, or you know that you'll be selling a lot more of that. For example, when you buy a printer, the printer is not really your challenge, but the cost of cartridges over the lifetime of the printer is something you should look at for. Add-on pricing. These are options or add-on price with high margins are added to the product after the purchase decision has been made. For example, you keep hearing full option pricing, and when it comes to cars, let's add a camera, seat, leather seat, is it what have you, and in that order. Pricing models that are alternatives to outright purchase include subscription. For example, now the Microsoft model, for you to use your Microsoft Suite, you need to pay a monthly or yearly subscription. There's also licensing and franchising. Because I like food so much, I'll talk about some of the recent franchises we've seen in Nigeria. The KFC brand, the Burger King are all international brands, but we now have them in Nigeria. Now, what is value proposition and value chain? Please don't mix this up. It's very easy to confuse in an exam, but I'll read this out. A firm's value proposition refers to how the customers will value the characteristics of the product or a service. And let me ask a question. Why will I choose a KFC burger over a Burger King's burger, given the competing products and their prices? I don't want to go into the details, but this just explains why, for example, I'll choose an LV over a Primark or a Gucci over a YSL. How the firm executes its value proposition is referred to as a value chain. You see the difference? Value proposition refers to how the customers value the characteristics of the product or service, and how a firm executes a value proposition is referred to as a value chain. A firm's value chain comprises of the assets of the firm, how its organizations add value and exploit the firm's competitive advantage. The value chain encompasses the quality of the product, its functionality, the service that is included, the sale process, price relative to the competition. And let me give an example. recently we now have Global and the rest of them. I think Jumia Foods, what have you. I personally think that in today's corporate world and in relation to how people eat lunch, for people who don't bring lunch from home, eateries or restaurants that are not on Glovo, or sorry, let me say that are on Glovo on Jumia Eats or Jumia Food, I don't know what they call them, I've added something to their value chain, because it means that now I know that from the comfort of my office, I can easily order food as against having to drive out looking for a dispatch to pick it up. This is just to say that all of those things, whether there's delivery service, whether the delivery service is fast, whether there's discount if I order more than one, adds up to what adds together to make what makes a value chain. Now, conventional business models tend to be industry specific. For example, our natural resource producers or banks, brokers, service providers. These are the ones that we know. But the other business models, for example, if you go to the UK, you find that is it ginger nuts, or the US, Costco has their own brand of ginger nuts. They have their own brands of digestive. They have their own brand of shortbread. So what this means is that there are companies that produce products for others to market under their own brand name. So they can produce for Costco, produce for what are those UK brands? Produce for, it's not coming to me now. Walmart, produce for the rest of them, but it's one person producing. So when I produce for Walmart, I put the Walmart brand on it. Yes, make it branded for Walmart. When I produce for Costco, I brand it for Costco. Or when I'm producing for, let's say even Next Cash and Carry in Nigeria, brand it for Next Cash and Carry. The organizations that do that. And they're also value-add resellers. They offer things such as installation and service and support or customization for complex equipment. I think the closest I can see in Nigeria are those DSTV operators. After you bought your DSTV, there are people, they call them, I forgot what they call them now, aside the DSTV office, or even sometimes inside near the DSTV office, they are the ones that help you. They offer all those add-on services after you have bought your DSTV. Now, there's also licensing agreements where a brand is used by another company on its products for a fee. I realize that, for example, when I'm shopping for my children, my children like Spider-Man, or what's this popular one, Barbie. If, for example, a Gap or an Old Navy is able to put the Spider-Man brand on a T-shirt, it's going to be at an extra fee. But what that also means is that Gap or Old Navy or Primark or whatever, you can sell it at a higher price than they would usually sell their products. Now, let's talk about investors and other stakeholders. We have 23 minutes to go. So what is the value of the firm? The value of a company is the sum of the value of its debt and the value of its equity. Now, the financial claims are motivations of lenders and shareholders of a company. Who are owners of the debt, owners of equity, and the show contractual claim on the interest and principal payments that the company has promised to make. Owners, on the other side, have a residual claim on the company's net asset. That is, lenders have a higher priority of claims than equity owners. Because debt is less risky than equity, it is also a less costly form of capital intuitively. Now, but both debt holders and equity holders can potentially lose their entire investment if a company fails. What this means is that even though debt holders have a higher hierarchy in terms of claims, if a company fails to the level that there's nothing to recover, both debt holders and equity holders lose everything. But their losses cannot exceed the amount of what they have invested. So a key difference between debt and equity investments is their upside potential. I've talked about this before. And regardless of a company's success, the best result debt holders can achieve is their interest and payment. But equity holders, on the other hand, can get so much more. So what this means is that this creates a conflict of interest. And I'll break this down. As a shareholder, taking more risk means that I'm increasing the possibility of the company to make more profits in the future. But what that means on the other side is it might reduce my ability to then pay my debt holders. And there are measures in place that debt holders can put to fight all of this. But bottom line, what this means is that because equity holders have unlimited upside potential and debt holders only have access or are only privy to the interest and the principal, there's a conflict of interest that comes up between both of them. So increasing leverage can increase the return on equity as long as the expected rate of return on assets exceeds the cost of debt. But it also means that generally it becomes more difficult for you to pay your debt. Now, we have different groups of stakeholders, and the primary stakeholders of the debt holders, people who have provided debt to the firm, the board of directors who have been assigned or elected by the shareholders, the senior management who have been elected by the board of directors, the employees who are involved in the day-to-day running of the business, the creditors who supply some of the firm's products or services on credit, the suppliers who supply the firm's products, and the government that makes sure that the firm or the organization follows the rules that have been set by that country. Now, under the shareholder theory, the primary focus of corporate governance is the interest of the firm's shareholders, which is to maximize the market value of the firm's common equity. Under this theory, corporate governance is primarily concerned with the conflict of interest between the firm's managers and its owners. That's under what theory? The shareholder theory. But like I just said, we have a lot of stakeholders. But the stakeholder theory now postulates that a company needs to balance the interests of all these categories of stakeholders that I mentioned before now. Now, in talking about ESG factors for corporate issuers, there are now ESG factors that investors now take into consideration. And what are the reasons that investors now take ESG factors into consideration? There are three major ones. First of all, the government stakeholders increasingly prioritize climate change and social policies through regulatory changes. Secondly, ESG factors can have a material impact on a company's results through potential loss of customer goodwill and financial losses due to fines and judgment, others to advance personal interest. Lastly, many younger investors increasingly manage their wealth with ESG considerations in mind. Before we go into what other ESG factors are, let's talk about what negative externalities are. They arise when a company or its investors do not bear the full cost of its actions. For example, when something is produced and there's some sort of environmental damage, increased government regulations and stakeholder awareness necessitate companies to recognize this cost either explicitly in their financial statements or implicitly. Now, when we say ESG, what do we all understand by what ESG factors are? Let's start with the E. The E is environmental factors. They include company contributions to climate change, air and water pollution, deforestation, energy efficiency, waste management, and water scarcity. Now, what are social factors? They include the protection of customer privacy and information security, customer satisfaction, employee engagement, diversity and inclusion, labor relations, and community relations. I'm sure that most of us now see that beyond the usual reporting that most companies do right now, things like sustainability reports, sustainability factors have to be taken into consideration in publishing their financial statement. There's also the role of corporate governance, which has factors that include composition of the board, executive compensation, the internal audit function, bribery, anti-corruption, and political contribution and lobbying. In recent times, or let me not say in recent times, but again, in recent times, these factors have become more important for those three reasons that I've said on top. Government is now monitoring this. ESG factors can lead to potential losses, and a lot of investors are manage their wealth with ESG considerations in mind. Now, for organizations, they must analysts should identify and measure ESG-related risks to which a company may be exposed and how they can affect the company's future cash flows. Equity investors may bear the brunt of the risk from adverse outcomes. Like we said before, because of relationship and the hierarchy of claims, debt investors have less exposure to adverse events unless they result in losses large enough to bring about default. But generally, analysts should be able to identify and measure ESG-related risk and see how it will affect one's investment in a corporation or an organization going forward. Now, let's talk about corporate governance, conflicts, mechanisms, and benefits. Now, we know that they're owners of business and they're managers of business and they're different stakeholders. Because all of these stakeholders have different relationships or have different interests in the business, there's something called principal-agent relationship and the conflict that may arise between these categories of stakeholders. The principal-agent relationship refers to owners employing agents to act in their interests. For example, the owners of the business are not usually the ones managing the business. And conflicts can arise because the agent's incentives may not align with those of the owners of the business, are not the same as those of another group. So agency costs arise because of what? Owners of the business now put measures in place to ensure ensure that they are not taken advantage of by the people who run in their business. So agency costs are the cost of principal agent conflicts, and they can be direct, such as the cost of hiring employees to monitor the agent, or indirect, such as the opportunity cost of lost business. Now let's look at the kind of conflicts that may arise. Conflict of interest between shareholders and managers or the directors. That's the most common one you have, the owners of the business and the ones who are running the business. There's also a conflict of interest between the different groups of stakeholders, like the suppliers, the debt holders, the employees, the managers. And there's conflict of interest between the creditors and the shareholders. Now, corporate governance and mechanisms, which one? For example, what's corporate governance? Like internal controls and procedures of a company that delineate the rights and responsibilities or the in case there's, but there's also the stakeholder management, which refers to the management of companies' relationship with stakeholders and is based on having a good understanding of categories of stakeholders. So let's look at how to manage this mechanism. Corporations typically hold an annual general meeting where at the end of the fiscal year where major decisions are made. Like annual general meeting, most other resolutions are made, such as approval of the auditor and general election of directors, or just major, let's say minor decisions or major decisions, but the other resolutions that cannot wait for or that go beyond annual general meeting, such as those regarding a merger and its takeover, or that require amendments of corporate bylaws, that attempt special resolutions, and may require a super majority vote of passage. What that means is that 2/3 of the shareholders or 3/4 must cast their votes. Such special resolutions can also be addressed at extraordinary general meeting, meaning that beyond annual general meeting, they might call for extraordinary general meeting to resolve such challenges. Now, we have activist shareholders. When you have a group of shareholders, there are some that are more active than the other. And what this means is that they're more involved and more interested in the decisions that are made. And they can pressure companies for changes that they believe will increase shareholder value. And they may seek representation on the board, propose shareholder resolutions, or initiate shareholder lawsuits. Now, generally, this should be good for all the shareholders. But what if some group of shareholders have a different interest apart from the other shareholders? Now, a group may initiate a proxy fight in which the group seeks the proxies of shareholders to vote in favor of its alternative proposals or make a tender offer for enough shares for a company to gain control. There's also creditor mechanism, which includes bond indentures. What this means are that covenants are things that are allowed or collateral that prevent or protects the bondholders in the event of a default or what have you. And there are also credit committees or ad hoc committees. In case there's a challenge, creditors come together to form a committee that makes them a formidable force to go against or ensure that claims from the organization is including laws and the employees here. Well, contracts are the primary mechanisms for customers and suppliers, because what that means is that before I can supply, you must reach an agreement, and there must be a contract that stipulates my rights and what protects me in the event of regulations that governs companies' actions, and they often do so by establishing agencies to regulate industries. All of these are measures put in place to help manage the different or the rights of the different categories of stakeholders. Then we have board of directors and management mechanism. The board of directors is elected by the organization owned by a group of people. They elect the board of directors that help them manage their business. The board of directors elects the management or chooses the management of the company. A board of directors typically has committees made up of board members with particular expertise taking care of different areas of the business. And these committees report to the board, which retains the overall responsibility of the various board functions. Because of time, I won't go into all of the details, but we have the audit committee, we have the governance committee, the nominations committee, and the compensation committee, risk committee, and just based on their names, you can see what aspects of the business that the focus on. For example, the risk committee informs the board about the appropriate risk policy and risk tolerance of the organization and oversees the risk management process. The risk of poor governance include weak control systems, poor decision-making, legal risk, reputational risk, and default risk. Good corporate governance can improve operational efficiency and performance, reduce default risk, reduce the cost of debt, and improve financial performance and increase value. Let's to capital structure. What is capital structure? Like I said earlier, a company's capital structure refers to how its finances and assets, you have debt or you have equity. In general, a company will choose a capital structure with weight capital. So when we're talking about a capital structure, right, we're talking about values of both the debt and equity, not the balance sheet value. So now, how do you now know the cost of my capital? How much is it going to cost me to have so amount of debt and so amount of equity in my structure, right? Generally, weighted average cost of capital is just using weighted average or weighted arithmetic mean, no, weighted mean, sorry, not arithmetic mean, to calculate the cost of capital, which is the weight of debt multiplied by the pre-tax cost of debt, but debt is tax deductible. So because of that, you are going to multiply by 1 minus the tax rate, plus the weight of equity multiplied by the cost of equity. So that's the general formula for calculating weighted average cost of capital. But now the weight for debt and equity can be target weight. Sorry, we talked about that. Factors affecting capital structure and weighted average cost of capital include internal and external factors. And what does this mean? We may view these factors that affect capital structures as those that determine companies' capacity to service debt. And this means that on an internal basis, for example, what is the characteristics of my business? Am I the type of business that has a lot of, that is quite liquid? What is my existing debt level? What is my corporate tax rate? The higher my tax, of course, the cheaper debt is for me. What was the life cycle of my business, and what is my management preference? These ones are specific to me as an organization, and they affect whether or not I had debt or the amount of debt or the amount of equity in my structure. Now, the external factors such as market and business cycle conditions, the regulation, which is what is allowed, and what is the industry norm for the industry that I'm. This proportion of debt in the company's capital structure, they include the growth and stability of revenue. The more stable my revenue is, of course, the more debt I can go into. Growth and capability and predictability of cash flow. If my cash flow is predictable, then it's easier for me to take a debt knowing that my source of paying back is more predictable. The amount of business risk and the amount of liquidity of a company assets and the cost and availability of debt financing. What this means is that even if I'm able to take debt, if the cost of it is too high for me, will I still be going for it? Depending on the life cycle or the stage of my business or the business environment that I'm operating in, there's also the case of how available is debt for me. For example, let's look at a sole proprietor and a corporation, which one has more access to debt. In general, the more stable or predictable and recurring a company's revenues and cash flows are, the higher proportion of debt it can have in its capital structure. The types of assets companies use to generate revenues also affect the ability to issue and service debt. For example, creditors tend to view tangible assets as better collateral than intangible assets. And of course, that will mean it will affect the cost of the debt and also even the availability of the debt, especially when those assets can be sold for cash. In addition to the size of assets, other issuer-specific conditions include the level of existing debt and volatility of revenues and earnings. I've talked about this. Now, let's talk about Modigliani and Miller propositions about the capital structure. The first proposition is proposition 1 with no taxes, and this just means capital structure is irrelevant. Here, demonstrates that under certain assumptions, the value of the firm is not affected by its capital structure. That is, the results referred to as the MM1, and the assumptions are this: capital markets are perfectly competitive. The question is, in the real world, does that exist? Investors have homogeneous expectations. There is riskless borrowing and lending, which means people can always borrow, it's available, and it is riskless. There are no agency costs, and investment decisions are unaffected by financing decisions. Now, these are the propositions of MM1. And what that means is that regardless of the capital, regardless of what the firm's capital structure is, it doesn't matter what the whole pie is. So look at this here, saying that whether you have 40% equity or you have 60% debt, or you have 60% equity or 40% debt, the size of the pie is still the same. The value of the firm remains the same. Now, proposition 2 talks about cost of equity and leverage, and is framed in terms of firm's equity capital. Sorry, in terms of firm's cost of capital. What this means is that rather than firm value, it's framed in terms of the firm's cost of capital rather than a firm value like MM1, like that we just said. It's saying that based on the same assumption, MM1 states that the cost of equity increases linearly as the company increases its portion of debt financing. So the savings from increasing the amount of lower cost debt financing just offset the increased cost of equity capital. So based on this relationship, MM2 concludes that the firm's weighted average cost of capital is unchanged by changes in the proportion of debt and financing in its capital structure. So this is what this means. Based on this formula here, tax makes debt generally cheaper. But the more debt you have in your capital structure, the more you have to pay in terms of return for equity. So what this means is that even though you save some money from taking more debt because of the tax savings, eventually what you have to pay for the cost of equity offsets whatever savings you think you're getting from the cost of debt. So what this is saying in conclusion is that the firm's weighted average cost of capital is unchanged by changes in the proportion of debt financing in its capital structure. Now, let's now look at propositions 1 with taxes. The other ones was, the first proposition was without tax. Now let's look at the one with taxes. It concludes that a firm's weighted average cost of capital is minimized and its value is maximized with 100% debt. So this means that differential tax treatment encourages firms to use debt finance because the debt provides a tax shield that adds value to the company. Now the question is, what are costs that are associated with 100% debt in your capital structure? The differential tax treatment encourages firms to use debt financing because debt provides a tax shield that adds value to the company. But again, what does this tax shield mean? The tax shield equals the tax rate multiplied by the amount of debt in the capital structure. In other words, the value of a levered firm is equal to the value of an financing. But the assumption is based on the fact that there are no bankruptcy courts. However, we can expect this cost, also called cost of financial distress, to increase at higher levels of debt financing. Cost of financial distress are increased cost of that the company faces when earnings decline to the point where the firm has trouble paying its fixed financing costs. Now, based on all of this, let's look at what the static trade-off theory is. This is the theory that balances the cost of financial distress with the tax shield benefits from using debt. What this means is that there's an amount of debt financing in which the increase in the value of the tax shield, I know we're out of time. There's an amount of debt financing with the increase in the value of tax shield from additional borrowing exceeds the value of reduction of higher expected cost of financial distress, which means that you get to a point where additional debt will not be beneficial for you. And this is the point that presents an optimal structure of a firm where the work is minimized and the value of the firm is maximized. We're at the dot of time. Let me just finish this and then we can move on very quickly. So to maximize its value, a firm seeks to achieve a target capital structure on an average over time. That is the one that reflects management's belief about the optimal capital structure. In practice, it will usually be a capital structure that tends to fluctuate. So in practice, what happens is that the target capital structure fluctuates over time because this changes in value. Terms that capital structure tends to fluctuate around the target capital structure because market values of the firms and equity fluctuate. And management may choose to exploit opportunities in a specific financing source, or they may decide to just balance them back to what they think the optimal structure is. Cost of asymmetric information arise from the fact that managers typically have more information about the company's prospects than future performance than the owners of the company. At this juncture, I know I have to stop now. I don't know who I'm introducing, but I'm sure the person is ready. You can get, if you're in Abuja, you can reach out to me. I know where you can get a calculator from. I'll now end my class and hand over to the next class. My name is Mukwelola Jato. Like I said, I'm available on LinkedIn. You can reach out and I'm available to take questions and solve it. Apologies that time didn't let us conclude. So I look forward to answering your questions outside the class. Thank you very much, everyone. I'm handing over to the next.
Thank you so much, Mupelola. We really appreciate. Next class is derivatives, and Fola Abimbola will be taking it. Thank you.
Thanks. Thanks. Hi, everyone. So then for the next 1 hour, we'll be talking about it's not necessarily a heavyweight in the grand scheme of things, but the points from derivatives are important. So what I intend to do is I'll just give you like an overview of or the structure of the derivatives market, and then we'll go ahead to solve as much questions as possible. And if there are any questions or concerns that you have, you can always post a question in the question tab or reach out to me later on. So let me just share my slides 1 sec. I'm guessing everyone can hear me, right? Okay. I'll take that as a
Yes,
yes.
sir.
Okay. So first of all, what I would like to do is just talk about the LOSs and just emphasize something. So just a sec, let me share my screen. Where's my screen? Okay, I share this. Share. Just confirm you can see my screen.
Yes, we can.
Okay, so first of all, the first thing you need to have in mind with derivatives is that it's not calculation intensive. When you start doing calculations will be when you get into level 2. So this is more of you trying to understand the concepts. There might be 1 or 2 calculations, and there might be some trick questions where you have to do some calculations to kind of answer something where the answer is not a number, but the answer is more of the, okay, yes, this is right, yet no, this is wrong, or something, just to test your understanding of the concept, not really calculations. So a lot of them define contrast, determine the value of expiration at expiration and profit from a long and short position in a call or put. That might be a calculation. Calculate the forward price of. So this one, some of the things involve calculations, but there are just some things that if you try to start doing calculations, you might just be wasting your time. And at this point, your time is precious. So you need to kind of read smart. The next thing I would like to talk about is, let me try and share my screen again. Let me share. Yeah. So now this is, let me stop my share here. Share again. Right. Can everyone see my screen? Okay. So because of time, I won't be able to wait for responses. I'll just go on. So the first thing I would like to talk about before we go into questions is the structure of the derivatives market. Derivatives, like you've all read, are contracts. It's just a piece of paper, and they are derived from financial assets that you've learned about. So they are derived from equities, from fixed income instruments, from commodities and things that are, that are more financial assets. So it's a piece of paper, and without the financial assets, there wouldn't be derivatives. Now, the two classifications of derivatives are, hold on, let me project this. Right. So the two classifications of derivatives are forward commitments and contingent claims. Now, forward contracts, futures contract swaps, are forward commitments. And what makes them forward commitments is that the two parties, the long and the short, so if you are on the buying side and on the sell side, you have obligations to fulfill a role at the end of the contract. Now, for forward contracts, for instance, is an agreement to buy or sell an asset at the end of a predetermined period. So it's an obligation, the price is determined. So the price at which you will do it is determined, which is the forward price. Transaction typically done at maturity. Futures contracts similar, except that futures contracts are exchange traded. So they are traded on an exchange. Forward contracts are over the counter. Now, I'm sure you know what over the counter means. It means that it's traded outside of an exchange, meaning that two parties come together outside of an exchange and they structure the deal and they decide to go ahead with the transaction or with the agreement. Swaps involves exchange of cash flows and there are OTCs as well. Now, onto the next other side of the spectrum, we have contingent claims. A contingent claim is a right. So the reason why it's a right is because you're paying for it. It's something you pay for, you buy it. So one of the most common contingent claims is called an option. I'm sure some of you have heard of it. It could be a put or a call, and you pay something called a premium, and it gives you the right to buy or sell an asset at the end of the contract. Now, you don't have to do it because you paid for that right. If, for instance, at the end of the contract, you decide, I'm not going to go ahead with this contract, you have a right to do that. So it's more of a premium. And um, the next one is credit derivatives. Credit derivatives are more complex. And the most common type of credit derivative is this one, the credit default swaps. Credit default swaps is, hold on. Credit default swap is similar to insurance in the sense that, I'll give you an example. You own a corporate bond. Now we know that corporate bond carries default risk. What then happens? You then decide, okay, I'm scared that the bonds or the issuer of this bond is going to default. Who is an issuer? So the person that borrows money, which you lent money to by buying a bond, that person is going to default. What do? You go and meet an investment bank and you say, I need a default swap, something that is similar to what's it called? To insurance, whereby if this party defaults, I would be compensated by the insurance company. So that's what it is. It's simple, it's similar to insurance. The only difference between credit default swaps and insurance is that for insurance, you have to have insurable interest. For credit default swaps, you don't need to have insurable interest. What do I mean by this? It means that you don't have to own the corporate bonds for you to buy a credit default swap on a company. So I can go and meet let's say let's say CFA Institute issues a bond and I decide I'm not going to buy the bond. I can also go and buy a credit default swap on CFA, even if I don't own bonds on CFA. Institute. What then happens if CFA Institute defaults? I still get paid by the investment bank, which is acting in the capacity of an insurance company. It's not an insurance company. The license is not an insurance company, but the license is an investment bank that is licensed to sell credit default swaps. So that's the most common type of credit derivatives. So this is what the overview of the market looks like. Let me see if there are any comments or questions. None. Okay, good. Good. Okay, so now I'm going to go straight to questions, to the past questions, because I want to cover as much with the limited time that I have. So I'm going to stop sharing. Uh-oh. I'm going to stop sharing and reshare my screen. How do I do this? Can you share screen? Yeah, it is. Share. So please confirm you can see my screen once again. Yes, yes, good. Thank you. Thanks for the feedback. Now, we start with the first question. So now, the first thing I want to mention is a lot of these questions are designed to trick you. And not because CFA Institute is wicked, but it's because they just want to test your understanding of this concept. They don't want you to just cram and just come and pour out your mind. They want you to really understand. And so that's where you have to read smart. Now, the first question is this. We have this professional. She sells 4,000 equity index future contracts at this price, 224. Now, what did they say? She's required to provide an initial margin. I'm just going to underline this. An initial margin of 20 euros per contract and meet margin call when her margin falls below the maintenance margin level of 12 euros per contract. Now, this is standard. This is understood because this is in the curriculum. They were explained that what happens, you get for futures contracts, you get a margin call when when the amount in your margin falls below a certain level. What level is this? It's called the maintenance margin. Once your initial margin falls and falls below this maintenance margin, which is 12 euros per contract, you get a margin call. And what does the margin calls ask you to do? Typically, by the practices in the industry and by CFA standards, normally you are expected to bring your margin back to your maintenance margin. So let me see if I can. Hold on. Yeah, I always have issues with this. Okay, so you are expected to bring this 12 back to 20 normally, but this question is saying that, where's the eraser? Oh, I don't like this. Okay, anyway, it's saying that in the event of a margin call, look at this. In the event of a margin call, the exchange requires additional margin to be contributed up to the maintenance margin level. Now, this is different from the normal standard. Under the normal standard, you are meant to bring it back to your initial margin. And the question is saying in this instance, you only have to bring it back to your maintenance margin. Now, we'll look at this. The price of the contract over the first, second, and third day is this. Look at the prices. Now, what are they asking? Based on this information, the balance on this margin account at the end of day 3 is what? So now let's look at this. Let me see if I can erase all this that I've done. Can't find the eraser, unfortunately. Is this the eraser? Okay. Okay, so I'm going to go back here. Now, on day 1, what happens? On day 1, the price of the underlying asset goes up. It goes up, yeah. Now, what does this mean? Is this good for her or bad for her? Let me see. Can anyone answer? Is this good for her? She's short a futures contract. Is it good that the price went up, or is it bad that the price went up for her? Bad. Thank you. Thank you, Ari. Thank you, HR. Now, what then happens? Her margin account, the balance of her margin account falls by the difference between this 234 and 224. So her margin account on day one falls to what? Falls to $2, which is 12 minus 10, right? On day one, her margin account falls to $2. Now, what does she have to do? She only needs to bring $10. If the question did not ask us, if the question did not state this, that it should be contributed to the maintenance margin level, we would have had to bring how much? We would have had to bring $18 to take us back to 18 euros to take us back to 20 euros. But now it's saying that we only have to contribute it back to the maintenance margin level. So what we do is we bring $10 and our margin is back to 12. Sorry about my writing. Day two, what happens? The same thing. The price of the equities index future rallies by another $14. So the difference between this 248 and 234 is 14. What happens? Now, her account becomes 12 minus 14, which is equal to her account becomes minus 2. Now, let me ask everyone a question. How much would she be required to contribute to bring back her account back to maintenance margin? How much would she be required? 14, thank you. So 14, you guys are on fire. 14, thank you. So now, 14, she brings back 14. So she brings back 14 and her account is back to 12 euros. Now, on day three, the price goes down. What she wants the price to fall. The price falls by $18. So 248 minus 230 is 18. Now the amount in her margin becomes 12 plus 18 plus 30. So on day three, the amount in her margin account is 30 euros per contract. Now we need to find how much the total amount would be. How many equity index futures contracts did she sell? She sold 4,000. So the amount will be 30 multiplied by 4,000, which will be 120,000. So the problem is, if you were cramming calculations and you were cramming formulas, you probably would have found it more difficult to get this. But if you would just try to understand the concept of initial margin, maintenance margin, margin calls and all, it would have been easier to do this. And you see that the calculation is not too intensive. It's more of arithmetics, plus and minus and all. But it's your understanding that matters here. Let me see if there are any questions. So someone says C. Okay. I don't understand, seriously. I'm sorry. For time, I can't really explain much. But what you could do is you could go to the either Schweizer or the curriculum, just search for, do a control F and search for initial margin or maintenance margin. You'll see like a literature on it. And I think it's explanatory. Also, I have some slides. After the class, I can share my slides. I didn't want to go through the slides because of time, because I want to go through as much questions as possible. But you can go through the slides, which gives a summary of the whole thing. Now, but I hope, let me just give you a brief explanation and I hope you would understand. So what happens is, when you enter a futures contract, you are expected to provide a margin, and the margin you are expected to provide is called an initial margin. Initial margin. Now, there's also something called a maintenance margin. And the reason why there is an initial margin is because the exchange uses this to manage default risk. Because what happens if you cannot pay that amount, or if for instance, when the price goes against you and you cannot cover yourself, the exchange uses that margin to cover the position. Now, the first one is your initial margin, which is $20 in this instance. Now, there's also a maintenance margin. The maintenance margin is like a threshold. If the amount in the margin falls below this maintenance margin, which is 12 in this case, normally, generally, in the CFA standard and even in practice, you are supposed to bring back. So if the amount falls below this $12, you're supposed to bring back the amount in your margin back to your initial margin, which is $20. Now, the question was saying that in the event of a margin call, the exchange requires additional margin back to the maintenance margin level, which is different. But that's what the question says, and that's what this exchange wants. So that is when you know that there is a difference. So now, if the amount falls below this $12, you only have to bring it back to $12. Yeah, so that's the best way I can explain it. Okay. The next one is, let me go to the next question, but let me first try and erase all this. How do you erase all? I need to get rid of all this. I could just erase everything at once. Okay. Now, let's go to the next question. The next question is, which of the following statements is least correct? We talked about this in the slide I showed you. So, which is the answer here? C. Okay, is least correct. Yes, a credit default swap is not a forward commitment. So C is correct. Now let's go to the next question. Next question is 10. Sorry, 1 second. 102. So 102. Which of the following is least likely to be the reason for an arbitrage opportunity to remain unexploited? What do we think the answer is here? Why wouldn't an arbitrage be exploited? C. Now, let me just explain it. Now, the reason why C is the answer is because arbitrage usually is supposed to bring an inefficient market back to the equilibrium price. Now, in a market, the best price should be the equilibrium price. So when you are doing arbitrage, it's not unethical. You are actually helping the market to bring it back to the market reflective price, so which is the equilibrium price. So you are taking advantage of mispricing where you are bringing the price back to the equilibrium level, and it's not unethical. The other ones are not reasons. Actually reasons why you wouldn't exploit arbitrage opportunities. So if this transaction cost is high, that it erodes all the profit you make, why would you go into it in the first place? If there's difficulties entering into short positions, because a lot of arbitrage positions involve short positions, and what short position just means is you selling an asset or you selling something, a security that you don't have, and buying it later. Okay, now let's go to the next question. I doubt you would get this kind of question in the exam that tells you to start calculating stuff. But just to fulfill all righteousness, I think we should just do this question. Now, Satoshi Takada takes a long position in a 9-month equity forward contract with a forward price of, so this is Japanese yen, 1684 per share. After 4 months, the price has increased to 2087 and the annual risk-free rate is 1.44. Based on this information, what is the value of the contract? Remember, there is the forward price. Hold on. There is a forward price, which you can calculate by, so if you're long the forward, and then there is the value. There is a value of the forward contract, which is our S at time t minus the present value of the forward price, 1 plus R T. 1 plus RT. Now, they've given us everything. All we just need to do is plug in the numbers. We have the forward price. We don't need to calculate the forward price. We have what the price has increased to. We don't need okay, they didn't give us the price at the beginning of the, but we have the price of the underlying. We have the forward price. We have the risk-free rate. All we need to do is plug in our numbers. So what do we have? We have our 2087.54 minus 1684.2 divided by 1.0144. Now, this is where it gets tricky. So what happens? We took a 9-month contract. This is 9 months. After 4 months, so this is 4 months, we want to know the value of our contract. Now, we know the forward price. We know what the price of the underlying is right now. But what we have to do is we have to discount the forward price from 9 months back to 4 months. So the difference between 9 months and 4 months is 5. So 9 minus 4, which is 5, divided by 12. So we are discounting it back, right? Now, so we plug in the numbers, we do our calculations. Let me see if there's any charts. We do our calculations, and the answer you should get should be, hold on, where are the options? Should be 413.34, so which is B? Yeah, so the answer should be B. Okay, so let's go to the next question. Hold on, let me try and erase all this. Please let me know if something is not clear here. Someone says a call/put option. Who writes the call and who gets the cash for the option contract? That's a good question. So put call parity. We'll talk about put call parity. Who writes the call? Now, who writes the call is the person that is selling. So you can either write a call or you can write a put. Okay? But think about it from someone that is buying the option. If you are buying the option, you are buying a call. A call is an option to buy an underlying security. If you are buying a put option, the put option is the option to sell an underlying security. Now, what happens? The other person at the other side of the contract. So if you are buying a call from somebody and you exercise your call, that person sells the underlying security to you. Now, that is a short call. Don't bother yourself about that right now. That is what you will see in level 2. From your perspective, always think about someone that is buying the option. So who writes the call is different. So who writes the call is the person that is selling the call to you and is the person that you will pay money to for that right. Now, who writes the put as well is also the person you are buying the option, and the person is taking money for you to buy the option, and you will then sell the underlying security if you exercise, and the person has to buy the security from you. So to your question, who writes the call? Who writes the call is the person called the short call. There are a lot of people that write calls. They are the ones that sells the call. Who gets the cash for the option contract? The person who gets the cash is the person that writes the call or writes the put. And that person is actually receiving a premium from you, so that if the person exercises, you are obliged, the person is obliged to fulfill his side of the agreement, which is if it's a call option, the person should sell the security to you because the person is the one that sold the premium to you. But you as the buyer, focus on the buyer. You are buying a call, you exercise, you are the one that would buy the asset from that person. You are buying a put, you exercise, you are the one that will sell the underlying to that person. Put call parity, please. Please use issuer and investor to explain. Right. So I can't really use issuer. Okay, I can. Okay, so now the issuer of the call is the person writing the call. And that person writing the call is the person that will collect the money for selling the call to you. Now, when that person sells the call to you, now the person selling the call to you is going to be the short call, which meaning that when you exercise the call, you are going to buy the underlying assets from the issuer. You as the investor would buy the underlying assets from the issuer, and the issuer has to sell the underlying asset to you. Okay? The writer is the issuer, the investor is the buyer. Exactly. But from a derivative standpoint, don't look at it as, because you could get confused in the question. From a derivative standpoint, just look at it as the writer. And yes, an investor, you can use an investor as a buyer, but a writer is an appropriate term for the person that is selling the options. I will talk about put call parity, then we'll move on to some other questions. Just give me a second, please. Put call parity. I'll have it here somewhere. Okay. Hold on. Okay. So now let's look at put call parity, and I have a slide here. So for put call parity to hold, let me share this. But for put call parity to hold, one thing must happen. Your protective put, which is you going long a stock, I mean standard, which is standard, your standard transaction of you going long is what's happening. Okay, so your standard, you going long a stock, and then when I say long a stock, I mean, or long an asset. When I mean you buying a security or buying an asset, and then you buying a put. This is standard. It's a protective put. So you buy an asset, you buy a put to protect yourself from any significant decline in the price. Now, that is one. The other part is called a fiduciary call, which means that you buy a call, and then you have some money that you have like the present value of the money that you would use to buy the call when you exercise. So we're assuming it's a European call, meaning it expires during maturity. So we have these two things. Now, what we are saying is that for put call parity to hold, your protective put, which is your long put and your long stop, must be equal to your fiduciary call. Now, this is all you need to remember. This law, this equation, hold on, let me annotate. This equation is all you need to remember. Because what then happens? In the exam, they could ask you, based on put call parity, what is the value of a put? All you need to just do is rearrange this formula. So the value of a put here is your x all over 1 plus r plus CO minus SO. So what does this mean? It means your negative means short. So it means that you go long, sorry, you go long a risk-free bond, you go long what's this? Yes, you go long a call and you go short the underlying security. It's the same thing with if they say what is the value of SO, you have to rearrange it and assume that your minus means you are short. Short means you are selling. So you buy this, you buy this. So for SO, you have your X all over 1 plus R into T plus CO minus P, right? So long, short. So that's just basically it. And you can look at the slides later on to get a better understanding. So that's basically your put call parity. Okay. I'd like to continue to look at the questions. Right. Our next question. This next question can be a little bit tricky. Let me see if there's any other question. Replication, option pricing. Okay. Let me just do some questions and we'll look at replication and option pricing. Now, this company has 40 million in debt, pays a fixed rate of 7.6. It expects rates to drop significantly and enters into a swap. Now, swaps is not something you would that is emphasized on in level 1, probably more in level 2. But the main thing we need to understand is this, or the question I want to ask is, you expect interest rates to fall and you enter into a swap. Which part of the swap would you be paying and which part would you be receiving? Would you want to, sorry, what part of the swap would you want to pay and what part would you want to receive? Especially when you know that interest rates would fall. Is it the fixed leg of the swap or would it be the floating, or would you want to pay the fixed leg of the swap or would you want to pay the floating leg of the swap? Yes, pay floating, receive fixed. Exactly. So you would want to pay floating and receive the fixed. So now this person enters a pay floating, receive fixed swap contract with these terms. The notional value is this based on a 360-day convention. Now, what they are asking, the question is not even asking for an answer. The question is saying, what will happen at the end of the contract? Now, let's look at it. Now, what do you have? You have some of this information is distracting information. But what will happen is we need to just think about what we are going to pay and what we are going to receive at the end, or sorry, at every leg of the contract. So where is my, okay, so now what do we have? We have our 4%, which we are receiving because we expect interest rates to go down. So we want to receive the fixed aspect of it. Then we have our minus 1.3% plus 1.8%. So it's all in the question. LIBOR is now 1.3%. And we are saying that we are going to pay LIBOR plus 1.8. So that's why I added 1.3 plus 1.8. Okay. Now, what else do you have? You have to bring it back to, so the amount would be, the amount is annualized. So you have to bring it back to the prorated number. So that's why I'm saying 90 divided by 360. Okay. And then what do you do now? You then multiply it by 40 million. So let's go over it again. You receive 4%. That's why it's positive. You pay 1.3. You pay LIBOR plus 1.8, which is 1.3% plus 1.8. Now, to prorate this number, we have to bring it back. We have to say 90 divided by 360, which is the exact payment, not the annualized, the exact payment that we'll receive. Now we'll multiply it by the notional principal, which is 40 million. Now, when you solve for this, you should be getting, so you should be receiving 90,000. The reason why you should be receiving 90,000 is because the interest rates actually fell as you expected, and it fell to 1.3%. Now, it's an asset to you. So what are they asking? The 90-day rate, 90-day LIBOR rate on day 360 corresponds with swap payment of A, 690. No, it doesn't correspond to any swap payment of 690. It should actually be 90. A swap payment made on day 450. Now, B should be the correct B should be the least correct. Okay, so A should be the correct answer because A is the only wrong one. C company XYZ actually receives 90,000. The payment is made on day 50, day 450. Now, how swaps work is, and you'll see this in level 2. How swaps work is the payment is not made on that day 360. On that day, the payment is made 3 months later. But I'm sure you've read it in the curriculum, you've read it in Schweizer. The payment is not made exactly on that day. Is made on the day on the next quarter. Sorry, the next three months, which is the next quarter. What does B mean? So B means that, like I said, the payment is made. Sorry. So he said the 90-day LIBOR rate on day 360 corresponds with a swap payment made on day 450. So it's going to be made 90 days later. It's a 90-day LIBOR rate. So the way swaps work is, if the payment is not going to be made on that day, what happens is what people do on that day is just to calculate the present value of the payment from 90 days. But for simplicity's sake, just remember that when it is swaps, on the day of the, what's it called? On the day that you do the calculation, on the day of the calculation is not when the payment is made. The day when the payment is made is a quarter later. If you don't understand it or if it seems confusing, please don't worry about it. I highly doubt that you will be asked this kind of question in the exam. The next question is, which I think is likely that, I mean, you might not get a calculation question, but it's based on the binomial, and I'm sure you've seen the binomial option pricing. It's been talked about briefly in the curriculum, and this question is similar. The question is just saying you have your you have your the value of your price. Sorry, hold on. Our S plus is 1.2 because the price is going up by either 20%, so 1.2, or our S minus is 0.9. And the way I just got it, you just say 1 into 1 plus 20%, or for so this is for up S plus, for down is 1 into 1 minus 10%, or 1 minus 0.1. So that's how I got my S plus and S minus. Now, the question is saying, it's very standard. What is the value of the option? So, what we first need to do is to remember the formulas. The formula for a call using the binomial model is this risk neutral probability multiplied by C when the price goes up, plus 1 into this pi minus, sorry, into C minus divided by 1 plus R. So which is the risk premium. Sorry, which is the risk-free rate, not risk premium. Now to get our this pi, it is 1 plus R minus D. Now divided by U minus D. Now, all these things, how they came to this formula, there's a literature behind it and there's a way they proved it. I'm not going to go into all that, but these are the formulas. So what then happens is we first calculate what our hold on, what our C plus is. What did they say? They say that so our S plus, first of all, so our S plus is equal to 566 multiplied by 1.2, right? Because the price is going up. Now, what is our C plus in this instance? Our C plus is equal to of maximum of so this, sorry, 566 times 1.2 should give you 679.44. Now, our C plus is maximum of this 679.44 minus 600. So I made a mistake here. Yeah, sorry, I didn't make a mistake actually. So minus 600. Now, this is the value of a call. So the maximum of our ST minus the strike price. So this is the price of the underlying. This is the strike price. So our C plus should be equal to 79.44. Our C minus would be, so our C minus is, let me put this here, maximum of 600 minus, sorry, actually not 600, we first need to calculate what our ST minus is. Sorry, 1 second. We first need to calculate our ST minus. Our S minus is equal to 0.9 times 566.2, which is equal to 509.58. And then we have 509.58. Our C minus then becomes maximum of 0 into 509.58 minus our strike price, which is 600. So our C minus will be 0. Now, we have our C plus, we have our C minus. What do we then need to do? We need to calculate what the risk neutral probability is. So the risk neutral probability, which is the formula I've given here, is going to be 1 plus our risk-free rate, which is 0.03, so 0.032 minus 0.9 divided by our 1.2, so which is our up factor, our U factor. So this is U. So our U factor minus 0.9, which is our D factor. Now, when we calculate this, we should be getting 0.44. So what then happens? We have our C plus 79.44, C minus 0, pi equals to 0.44. So what then happens? We then calculate what the value of our call at time 0 is, because now we have all our figures. So our C is equal to 1 plus 0.032 minus 0.9 all over 1.2 minus 0.9. So you should be having 33.87, which is B here. We don't have much time left, and this always happens. I'm sorry. I'll try and do less calculation questions, and so let's just quickly look at some basic questions that don't involve calculation. So because of time. So the next question is, in comparison to underlying spot markets, derivative markets tend to be what? What do we think 98 is? What do we think the answer is? In comparison to underlying spot markets, derivative markets tend to be A, less liquid, entail higher transaction costs, offer easier access to leverage and short positions. C, thank you. The next question is, I'm going to skip 99. So let's look at the typical kind of question you might get on the swaps. BWC Chemicals is a fixed rate payer on a plain vanilla swap rate. Since swap rate commencement, interest rates have fallen. Which of the following is most accurate? Number one, the swap would be an asset for BWC. The swap fixed rate will have fallen. The present value of the floating rate will be lower than the present value of the fixed rate. Now let's dissect these options. The first one says the swap would be an asset for BWC. BWC pays fixed rate and receives floating. So gets fixed. Sorry, pays fixed. So this should be minus fixed. So minus fixed comes out of BWC's account plus floating. But interest rates have fallen. So what happens? The swap will not be an asset for BWC because BWC is paying more than it is receiving. But the swap will be an asset to the other person. So the counterparty will be an asset to that person. So this is wrong. The second one, the swap fixed rate will have fallen. The fixed rate of a swap never changes. It's an agreement. A swap is an agreement with a fixed rate. The only thing that changes in a swap agreement is the floating rate. So this wrong. The present value of the floating rate payments will be lower than the present value of the fixed rate payments, which seems accurate because the floating rate payments will be lower. So BWC will be paying a lower amount than it is receiving. So C should be the answer. The next question is a very quick question. The price of an underlying security is currently $5.20. A put option with an exercise price of 5.28 has a premium of 0.08. The put is currently what? In the money, at the money, out of the money. What do we think the answer is here? 101. In the money, at the money, out of the money. Out of the money? Who else? Yeah, so the answer should be A. The reason why it is A is because it's a put option, number one. So number one, when you are long a put option, you want the underlying price to fall. Now, when you are doing in the money, out of the money, at the money, you are ignoring this premium. This premium is just a distraction. Now, hold on, let me erase something. And a lot of people get tricked by this. The moneyness of an option, which is in the money, at the money, out of the money, moneyness is not equal to the profit. It's not the same as the profit. Now, if you were to take the profit, if you are going to say, okay, is this option at a loss or at a profit? That is when you also include this 0.08. So what are they saying? They are saying they just want to know if it is in the money. When you are doing in the money, out of the money, you ignore the premium. Now, remember that the value of our put option is maximum of 0x and x minus st. Our x is 5.28, which is our exercise price. Our st is 5.2. Our x is higher than our 5.2, so it is actually in the money. So someone said, not moneyness. Okay, so A is the answer because it is in the money. Okay, let's do one or two more questions. I apologize to the person who wanted arbitrage, the no arbitrage and the replication. I'm sorry. I prioritized. I wanted to do more questions than explanations. Well, I have the slides, and you can reach out to the CFA admins, and they will provide the slides for you. And also, I'll try and put my email address. If you have any questions, you can reach out to me. I'm very open to providing any answer that you might need. So the next question is, which of the following statements is most accurate? Now this question is very important. I can't emphasize this question enough. Which of the following is the most accurate? Now there is the value of a European put. There is the value of a put or a value of an option, and then there is the minimum value of an option. There's a literature explaining the difference in the curriculum. Now, someone has already answered the question, but I would like to just explain before I round off. Now, the minimum value of an option is different from the value of an option. The minimum value of an option is the present value. So the difference is either zero or the present value of the exercise price minus the minus the spot price. If they were just asking for the value of a put option, you are not going to include present value. It will just be the minimum value of zero and the exercise price minus the spot price. But because they said the minimum value of an option, that is when you bring in time value of money. That's when it becomes X, the present value of our exercise price minus the underline. So let me just quickly do one more question and then we'll wrap up. Any exercise of an American option immediately before a dividend would most likely be warranted. Remember, an American option can be exercised anytime. So what do we think the answer for 103 is? Okay, I'll quickly answer. So now, exercise value of an option is most warranted um before a dividend for a stock call option. And the reason why this is so is because when you exercise a call option, you are buying a stock. You then own the stock. You receive the stock from the person, and then you hold the stock. Guess what? You earn a dividend. So that is why it will be warranted. The other ones are not warranted because when the carry cost is significant, you don't want to incur costs because you are holding the security already. For a put option well in the money, it's wrong because when you exercise a put option, you are selling an underlying asset and you lose out on the dividend. That wraps up my session. I wish you guys good luck. Enjoy the rest of your evening. Thank you.
Thank you so much, Paula. And it's a wrap, guys. Thank you to our facilitators for sharing their wealth of knowledge. Thank you for their time. We thank the sponsors, New Frontiers Learning Center, First Quartile Professionals, and Bratton Business School. We also say a very big thank you to our volunteers and, of course, the Society Office. Thank you, guys, for listening in rapt attention to the lesson. Thank you. To have a lovely rest of the day.